I think the banking system is going to get through this.
It's a very complicated environment. I think obviously the risks to the downside have increased.
The economy doesn't tend to just slow down, in a stable way. It kind of slows down, and then at some point, it really starts to deteriorate.
I think there's one rule right now. Don't overdo things.
We'll really have to watch whether there is a next shoe to drop here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Do you remember walking to school and just kind of slow walking it in so you were late? Is that Chairman Powell this morning?
I thought you were talking about me. I thought that you were.
No, I was talking about Chairman Powell going into a two-day meeting. You just kind of slow walk it, turn up a little bit late, and hope things change.
Well, maybe that's the best strategy at this point, because things are moving so quickly that who knows exactly what he's going to be facing. Precisely.
The two-day meeting begins today from New York City this morning. Good morning for our audience worldwide. Equity futures with a bounce, up 0.6% on the S&P 500. Here's the latest on the banking crisis, and I think we can call it that. This, according to our reporting, US officials are studying ways they might temporarily expand the FDIC coverage on all deposits, Lisa. So this is one extra step further.
Without any legislative backing in terms of how they insure all deposits. So this raises this issue. Number one, why now, right? Do they see more distress on the horizon? But number two, will this work? Has this already worked to stabilize sentiment, and will it last? Because we have seen stabilization in a way that we hadn't at the end of last week.
Do we face another weekend of this? JP Morgan's Jamie Dimon, we've said, is coming up with a plan. That's our reporting also yesterday for First Republic. My question over First Republic, Lisa, why is this institution so important to these big banks in America? Last week I was wondering the same thing. 11 banks coming together to help out a competitor in some ways. Putting $30 billion, depositing that in the institution didn't help. Down Friday, down aggressively yesterday. This morning it's a bounce. What kind of plan solves this problem?
So there are a lot of questions within that. The number one that I'll pick up on is, why do the big banks want to help this institution? It's a really good question. Is it simply because stability in the banking sector benefits them? Or is this because there are cross currents between the clients, especially commercial real estate, especially some of the wealthier individuals that have multiple accounts? So which is it? We don't know. But what you can say is they're trying to be on the front foot, get ahead of whatever kind of, finger pointing they're going to get in Washington when there are hearings on this. Is a good PR move, but it's also potentially helpful for the entire banking sector.
We started the program talking about speed, how quickly this has all moved, and I've mentioned this a few times. 2 weeks ago, that was a triple-digit stock. One bad day away from being a single-digit name this morning.
The moves have just been shocking. I mean,
amazing.
Yesterday's 47% decline in this name, as people basically try to shore this up. And we also heard about FDIC guarantees, and we have the liquidity lines that we've been hearing about, from whether it's the discount window that I know that First Republic tapped in big amounts, but also the federal home loan banks, which have also been extending a tremendous amount of credit. So at what point do we regain confidence? Again, we seem to see stability right now. Is that a sign of something that could last?
I've gone through all the calls for the Fed tomorrow. 25 this, on hold that. And I just don't sense any conviction whatsoever in any of the notes. Don't you get the same thing? So it's just like on the one hand, this, like, yeah, kinda, we don't know, and then they're going to pause and wait and see.
I read them all too, and I walked away being like, why does it even matter? I mean, maybe that's just where I go, but at a certain point, does 25 basis points really matter, or is it really going to be the signaling, right? I mean, if they do 25 basis points and they say we're not going to hike rates any further, will that have the same effect or even more in terms of a stimulative kind of message to the market?
TK would love that one, wouldn't he? Dovish hikes.
Well, he would also hate the discussion altogether. I feel like I'm sitting in this chair, and I feel like TK.
Well, you know what to say. You just say they're data dependent, and companies adjust and adapt.
I hate this game of the Fed prognostications.
It's not a bank. That's not a bank.
I will say this.
It's not a bank.
We miss you, Tom. I will say though.
It's not a bank.
I mean, you understand what I'm saying though about the Fed, right? Like if they hike by 25 or they don't, it's the signaling. I don't know.
Futures right now on the S&P. You fed up already? We've got another day of this coverage. We're positive about 5 or 0.6% on the S&P. Yields are bouncing up 4 or 5 basis points on a 10-year, 353. Take a look at the 2-year. We're back through 4% on a 2-year. Lisa up by 7 basis points, 4.04%. And I make it euro-dollar 1, 2, 3, 4 days of gains for euro-dollar just about.
It's dizzying when you take a look at some of the moves on the front end of the yield curve. And to be fair, I actually very much enjoy all of this, so I'm not sick of it. It's just as dizzying and exhausting, all of the different shifts in moods. Today we get some data. I ask, does the data matter in any way, shape, or form? Economic data, Philadelphia Fed non-manufacturing activity coming out at 8:30. At 10 a.m., U.S. existing home sales. What I find interesting is that the expectation for GDP in the U.S. has gone up if you take a look at the Atlanta Fed GDP Now index. So at what point does that matter for a Federal Reserve that is looking for some sort of progress in fighting inflation? Today, we get that two-day meeting that begins in Washington, D.C. The rate decision comes tomorrow. Look at that zigzag in the two-year yield over the past couple of sessions, the past couple of weeks. It's so hard to gauge the market's expectations, and it can move in a dime, which is part of the reason why I think there is this exhaustion setting in. We don't know. That's basically what we're reading again and again, a lot of the notes. And at 10 a.m., this is going to be really interesting. Treasury Secretary Janet Yellen is delivering a keynote address at the ABA Washington Summit. She's going to be talking also with the head of the American Banking Association. What does she say in terms of additional measures of support and why they are needed right now? How do you sort of get confidence in markets at a time when you also are saying we need to provide an even bigger backstop?
There's only so many times you can turn around and say the financial system is robust and resilient, right?
You never want to have to say that in the first place.
Robust and resilient, and then bank after bank is getting into trouble. At some point, you have to change policy.
You wouldn't be saying that unless there was a problem. You have to change policy, but then you have to say what measures you're taking and why they are necessary if there is this resilience and a stability in banking.
Marko Kolanovic over at JP Morgan said this in his note this week. The Fed is facing a difficult task, but it is likely already past the point of no return. He said a soft landing now looks unlikely with the airplane on a tailspin, a lack of market confidence, he said, and engines about to turn off. Bank lending. Steve Whiting joins us now of Citi. Steve, wonderful to catch up with you as always. Are we at the point of no return? Are we past that point?
Well, look, we believe that the U.S. economy was going to stall even before these banking events happened. There was a sharp tightening in lending standards before any of this news, commercial real estate, C&I loans, et cetera. The yield curve is giving us the same message. Now, the backward-looking data has still been strong. Employment data for the last couple of months have been stronger than we estimated, but there are discontinuities coming. There are industries that are going to have too many people working in them for the outlook to come. So we do think that a stall was here, but it really depends now where policymakers go with this. Are they going to take very definitive action to keep this within the boundaries of an economic slowdown with some areas of potential trouble? We can talk about what those are. Or are we going to experiment and see how bad this could be?
I assume that means either they keep hiking rates or they pause, not in that order. That basically if they pause, then you sort of have a shallow recession. And if they don't, you could have something deeper. Is that correct?
Well, it depends in part. I think policymakers, very standard policymaking will be that we can segregate these issues of financial stability, address this with particular measures aimed at financial stability and still conduct monetary policy in an independent way that focuses on backward-looking inflation. We disagree with that. We think that they do interact, that what has happened with this remarkable rise in policy rates going from overstimulus to a period of restrictive policy all within 1 year, that by itself has delivered a shock.
So how much will...
Rate levels so much, but this is going to mean that there's going to be a price to pay in the economy from that type of sharp move in policy tightening.
So, Steve, from your perspective, how important is this Fed meeting to determine your entire investing thesis, what guidance they give in terms of the approach they're going to take?
I think it can't be seen entirely in isolation. Again, if they go ahead with a 25 basis point move, what are the other actions that are being taken to keep confidence in the financial system? And we don't know. Maybe that everyone is satisfied with these actions so far. The discussion, for example, of making sure that banks of all sorts are not defaulting on deposits, that is a clear line in the sand. If that is the case and we can have stability in the financial system and they start to see that the actions that they've already taken, that the lag effects are still substantial, they have a window here again with the confidence in markets, I think, that they can slow down this policy tightening cycle or halt it. And we will still see a slowdown, and we will absolutely see a slower inflation rate. in the next 12 months.
Steve, I think we're all struggling, not just with capital allocation decisions, but also with the framework, the world, the backdrop that we're going through at the moment. This narrative has changed about 2, 3, 4 times over the last month for many people. At least the consensus view has, even if your view hasn't. This was from Bank of America in their fund manager survey. This is what they had to say. Expectations for stagflation have remained above 80% now for 10 months in a row. They said FMS investors have never had such strong conviction about the economic outlook. Steve, do you see it that way? Because it sounds like you're pushing back against this stagflation view.
Well, it's certainly not priced into the TIPS market, where we have seen 1-year, 5-year, 10-year inflation expectations coalesce with something that's fairly consistent where the Federal Reserve is. And again, how easy, how quickly we can achieve that is still to be seen. But we do not view this as an environment where backward-looking stimulus creates permanent increases in inflation, right? So I think that we're going to come down. We're not going to be at a 2% inflation reading by the end of the year, maybe very, very unlikely that it's at a headline CPI level. But in 2024, we're going to have a very low inflation rate. We're seeing the first declines in broad U.S. money supply, outright declines since 1948. Now, this is what happens after you go through a pro-cyclical monetary policy. 2021 easing with 6% GDP growth, 2022 sharply reversing course. And again, where we will be, monetary policy is only going to affect future inflation. We can't get the next CPI print to be weak.
Well, Steve, let's talk about what that means for stocks. The inverse correlation, looking forward to all of that, is clearly the NASDAQ. Steve, that's outperformed this year so far. Do you see that continuing?
Well, look, we think that the market is going to move beyond mere interest rate problems, right, to economic growth and credit problems. So again, high quality secular growth stocks could outperform in that environment, but it's not exactly an all rosy scenario for that particular segment of the market. It really comes down to the idea that what happens in financial markets, what happens in banking, is not going to be contained. There's not going to be zero effect in the economy. So I'm more worried about segments of the industrial sector, the material sector, small caps. Again, house the banks, but also other companies that are more dependent on credit and finance. And those that need outside funding will find it harder. There'll be a higher return hurdle.
Yep.
And we would expect earnings to drop this year in cyclical areas. So you've got to move beyond financials. And again, the tech sector did take the hit from rates. So we're less pessimistic on it.
Hey, Steve, you're not alone. Thanks for joining us. Steve Whiting there of Citi Global Wealth Management. The NASDAQ, Lisa, so far year to date, still doing pretty well.
Yeah, flying in some ways. Although, to Steve's point, it's an important one. How much is this because of resilience in the face of a more significant downturn versus just an interest rate play?
We came into this mess with pretty high nominal GDP. You wonder if we're one banking solution away from the conversation turning back to no landing. You know, it's changed so much,
well said.
So many times in a month.
Well said.
Who knows where we are a week from now? Equity futures right now, positive 5 or 0.6% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is studying ways to guarantee all bank deposits if the current crisis gets worse. That's a move sought by a coalition of banks. Bloomberg's learned the Treasury Department is looking into whether regulators have enough authority to temporarily insure deposits larger than the $250,000 limit without consent from Congress. The Federal Reserve faces a tough choice at this week's meeting of policymakers. Fed Chair Jerome Powell and his colleagues will consider whether the global banking turmoil is so concerning that an interest rate hike should be abandoned. They'll announce their decision on Wednesday. The UK, Swiss, and Norwegian central banks will also set rates this week. Joe Biden has issued the first veto of his presidency. He rejected a bill that would prevent a rule allowing retirement portfolio managers to weigh environmental, social, and governance issues in their investment decisions. So-called ESG factors such as climate change have grown in popularity in finance. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
this is a very different situation than the great financial crisis in the sense that the banks, this is a question of confidence in banks due to uninsured deposits and mark-to-market losses. It's not about the economy that's collapsing. In the last recession, during the great financial crisis, we were in recession beginning in December 2007. We're not in recession now.
Bill Dudley there, the former New York Fed president, speaking to us yesterday. This is what he had to say this morning in a Bloomberg opinion column. The following: the US Federal Reserve is facing increasing pressure to sacrifice its monetary policy goals for the sake of financial stability. This is a false choice. The Fed can and should fight inflation and contagion at the same time. Now, a lot of this thinking implies that the two objectives right now are somehow in conflict. Seth Carpenter of Morgan Stanley wrote over the weekend the following: the market volatility has the potential to tighten financial conditions and hurt economic growth. So, if a central bank refrains from hiking, it is not a focus on financial stability at the expense of macroeconomic objectives. Rather, it is trying to calibrate whether more hikes will push conditions so far that the real side of the economy is hurt too much. I know it's not the cleanest way of doing it. No one wants to do it this way, quite clearly. But everyone we've spoken to, I would say 90%, just to pick a number from thin air, something like 90% of the people we speak to over the last week believe that this situation and the banking turmoil of the past fortnight or so, the last 2 weeks, should lead to tighter financial conditions and tighter lending standards. So surely that complements the Fed's objectives around bringing inflation down.
To such a degree that people are trying to game out how many rate hikes it would be equivalent to if this turmoil in the banking sector continues. Bloomberg Economics has come out with a 50 basis point rate hike that has been implied if the turmoil does continue. Apollo's Torsten Slok, something similar. So exactly to your point, there is a commensurate kind of read-through of there. It just is a question of how far it can go.
Matt Lazzetti at Deutsche Bank made it pretty simple. The question the Fed's been asking themselves is how far away are we from being sufficient restrictive? Does this get us closer? Matt says this gets us closer. Isn't that the ultimate question here?
We also said that the Fed hikes until something breaks. And a lot of people could say this is something breaking until it isn't. And that, I think, is really even a bigger question, which is all of these stabilizing efforts. Does that basically take this off the table and raise the risk of inflation again? I mean, if you want to switch narratives quickly, there you go.
One name that has been breaking, First Republic. It's bounced in this morning. It's up by more than 20% in the pre-market. To talk about that, Ken Leon joins us now, Director of Equity Research at CFRA. Ken, 11 banks last week get together to deposit $30 billion. I get it. The stock doesn't like it. We drop on Friday, we drop on Monday. Now there are these reports that Jamie Dimon is somehow leading another coalition to do something else, to do something more. Ken, why is this name so important to these institutions on the street?
I think it's a symbol of financial stability where the large banks can work with the Fed to arrest any kind of panic or run on deposits. It's kind of like small cracks in the ice in the lake. And this is the one that really matters. Yesterday actually was a good day because what was in the red was First Republic and, of course, attention to Credit Suisse over in Europe. But a lot of the other banks really stabilized and moved higher. So we need another day or two of that in equities. But what's happening in these small cracks in the ice is really what will happen to the economy with small banks restricting credit to small business. And that gets into the narrative for rates and employment.
In terms of the echoes of 2008, this has a few, not very many, but one of them is a question around credit rating agencies and the credibility around them at a time when they are supposed to imbue some sort of confidence that there is oversight. First Republic downgraded very quickly over 2 consecutive weeks. We could see UBS now downgraded, even though the market says this is a good deal for it. What do you make of its role in this whole thing?
Yeah, from my experience, there is a lag factor, and it is quite different than 08, but it's a process of committees, and both the major rating agencies will notch down, if you will, in their ratings. Of course, the situation back in 08 was this frenzy of term sheets and doing deals and doing ridiculous valuations, and we're not in that situation. But ratings will come down, and it's just it's another reference to what this means about financial stability or the wherewithal of each of these banks. So yes, this process is happening, but it's a lag factor where I think you really have to pay attention to the Fed on the third guardrail, which is bank supervision.
And we'll get into that in a second. But Ken, From what you've seen so far, do you have confidence that we have seen all of the perhaps unseemly bodies in the closet of some of these banks?
I believe we have, and there's been enough time and enough light in terms of looking at any mismatches as it relates to deposit risk, duration risk, asset liability, near versus long-term mismatch. So I think we're there. I do believe we're there. But the thing is, the spark or this crack on the edge of the lake, for ICE is really depositors can take their money and go somewhere else. And I think that's the biggest fear to your first question, why the large banks want to say First Republic.
So, Ken, one thing that officials are considering now, according to our reporting, is that they're studying ways that they might temporarily expand the FDIC coverage to all deposits. Ken, I guess, one, is that likely? And two, would that basically solve everything?
The second question, I think it does solve everything, because then depositors will keep their money where it's at. And you have to remember is, there are $2.7 trillion in the third tier of banks, 10 billion to 100 billion of total assets each. That's a lot. And I think that's what's keeping everybody awake in terms of trying to have something which is really the bazooka shot here, as you just mentioned.
Ken, just to explore this one step further, if that became permanent, someone's got to pay that. And Ken, I wonder just how you think that might transform just the whole banking model in America, if that's the direction we go in.
In just a absolute basis, there's the moral hazard and the risk of what you do with those deposits. And then if you're going to have any stronger control there, you need to have an expanded regulatory supervision of these banks, small banks. That wasn't the mission in 2018. It wasn't the mission in the last week or two. It was really just to go down to banks of 100 billion or larger. But I think all these cracks in the lake are really happening below 100 billion, and that's the risk.
Opportunities in a crisis, Ken. It's always a difficult conversation, but where are they now?
I think we're in the period where we're past surprise and shock, and we're now beginning to move to what one called the forensic side of what happened, why did it happen, what can we do to remedy the situation. And last night I was just looking at the manuals of the bank supervision of the Fed, and they have great policies, they got great professionals. But again, you got to bring it down to a smaller scale banks, unfortunately. And that's going to slow down the U.S. economy and perhaps tighten credit where you don't want it and where job creation is, which is small business.
That's the problem. That's the big problem. Ken, thank you, as always. Ken Leon there of CFRA. Eco 101, there's no free lunch. You go forward with that, and that could really transform this whole banking universe in America.
So let's take a pause. That means basically insurance premiums that they've got to pay, right? It's something. Otherwise, how do you justify insuring all deposits? But then at what point do banks become more utilities and more heavily regulated and less a profit engine that can really capitalize on the model that they have of lending long and borrowing short?
Who knows whether it happens, but it's worth exploring if it did. The regulatory snapback would be brutal. The follow-through after that? You
have to imagine it's going to be to some degree anyway, because if they're already backstopping it, how do they basically say on the other side for, an election cycle, the taxpayer is not going to end up bailing out any depositor, especially those who are the wealthier ones who have more than $250,000 in the bank. I mean, you could say it's the small businesses, but still, this is a real issue for them. First Republic had a really difficult day yesterday. We've got a bounce this morning by a little more than 20% in the pre-market on First Republic. Elsewhere, futures doing okay. Better than okay, up 0.6% on the S&P 500, and yields back through 4% on a 2-year, up 8 or 9 basis points on the session. Welcome to the programme. The 2-day meeting for the Federal Reserve begins in a couple of hours' time. I was going to say right now, but I imagine they're still sleeping. Futures on the S&P positive by 6 or 7 tenths of 1% on the Nasdaq.
up by 0.4. What's that, Lisa?
You always slip that in. You're like, oh, they're probably sleeping.
Because they are. Although I must say, I'm sure some of them are logged on to the Bloomberg to see where some of these banks are trading in the pre-market.
I don't think they're sleeping that well these days. I've got to be honest.
I would agree with you.
Anyway, carry
Probably
on.
didn't have much of a weekend either, to be honest. In the bond market, 2s, 10s, 30s. Look a little something like this. Your 2-year up 10 basis points and back through 4%, 4.07, 6%. The 10-year a lift there as well. The whole curve shifting higher, slightly more inverted given what's happening at the front end, but still on a 10-year up by 5 basis points, 353.55. That inversion's gone from negative 110 to negative 53 on my screen at the moment. That's quite a turnaround, isn't it? Negative 53, negative 54 from where we were only a couple of weeks ago. In the FX market, euro dollar, the highest since early February, I believe since the payrolls report, actually. 107.50, let's call it. Euro dollar advancing for a fourth straight session, positive 0.2%. Central banks on both sides of the Atlantic say that they are data dependent. Dependent on what data is the right question. Is it this data point at the moment? First Republic, that stock in the pre-market with a bounce after getting absolutely hammered in yesterday's session, just short of 15, 14.97, Lisa, up by, let's call it 23%. After taking a real beating on Friday and again on Monday.
Maybe this is the data they're looking at, and that's the reason why we're getting that whipsaw up and down moving in the 2-year yield, because basically it just shifts on the day. That's got to be part of the discussion. How do they navigate trying to separate out financial stability from monetary policy when the two are intertwined? When they raised rates at the fastest pace going back to the early 1980s, we were just talking with Steve Whiting saying that you cannot extricate the two, that these are basically in tandem. We were talking about all the other economists. So how do they sort of draw a distinction in something that is absolutely interconnected?
There is a belief, I would say a consensus view now, that it's almost inevitable that we get these tighter financial conditions from the banking stress that leads to softer growth. I get all that. But I do wonder how that view might change if we do get something big this week, like some kind of blanket coverage on all deposits in the United States. If it moves in that direction, how quickly things might change again in the other direction.
You know, all I know is that right now people are trying to read one article, one author from the Wall Street Journal about what tea leaves in the quiet period they might hear. And that's what everyone's trying to do. And if the Fed would have signaled a change, then they would have done it. That's the thinking. So if they're going to raise by 25 basis points, to your point, does that necessitate that kind of blanket move on the other side from other agencies?
Dario Perkins of TS Lombard out of London, I know you follow some of his work as well. He put out on Twitter, the central banks are stuck between the ghosts of the 1970s and their PTSD from 2008. He said, I reckon PTSD wins out. If you think it's the former, though, and it's the 1970s, that risk of needing to reintroduce rate hikes again, I'm sure that weighs on them too. This whole idea of a flip-flop, which is what makes the pause, I think, difficult. Neil Dutter of Renmax said this, a pause-and-see approach would be tough to communicate and would likely send market to price even more rate cuts between now and year-end. Is that really what they want the outcome of this meeting to be? To price in an even bigger rate-cutting cycle?
Here's the problem. Do they even know what they want the outcome to be? Because are they coming with a clear guide of what the trajectory of inflation and growth is going to be like? None of us have known. This has been the issue, is that we don't know what kind of inflationary period we're in. Some people saying, Bob Michael of JP Morgan Asset Management, he said that idea of stickier inflation that sort of is persistent, off the table at this point because
2 weeks
of natural
ago,
tightening.
They opened the door to 50 basis points.
I know.
That was 2 weeks ago.
But again, it shows how quickly things are moving. But you're right. How do they have credibility at all if they completely change their narrative and their parameters for the inflationary outlook?
Greg Dacker joins us now to talk about this, the chief economist at EY Parthenon. Greg, let's start there. Chairman Powell, can he really get hold of a pause-and-see approach tomorrow?
I don't think that's likely to be the approach that they adopt. Let's not forget, as you were stating correctly, that just a couple of weeks ago, we were talking about the possibility of 50 basis point rate hike. The Fed continues, I think, to view the economy as excessively hot from an inflation perspective, excessively tight from a labor market perspective. That continues to be the perception of the data. I think that's to some extent misguided. And this excessive backward-looking data dependence is something that does expose the Fed to abrupt market pivots, something that the Fed does not want at this stage. But I do think they still go with the 25 basis point and adopt essentially a dual track approach by distinguishing price stability from financial stability.
Greg, let's dig into that a little bit. What data should they be looking at if the data they're looking at is so backward looking?
Well, I think it's an important element is to look at forward-looking data, look at where the trends are heading in terms of inflation, in terms of labor market. We did see a fairly strong jobs report for February and January. But if you look at the hours worked, if you look at wage growth momentum, you see that there is a slowing in economic activity on the labor market front. If you talk to business executives, they're being much more strategic about their decisions, both to hire and right-size their talent pools. If you look at consumer spending trends adjusted for inflation, there's a softening in the pace of growth. And there are underlying cracks in the foundation of household finances on the credit front. So this recent episode, where credit conditions are likely to tighten, will weigh further on economic activity, both at the business end and at the consumer end. That should point to slower inflation going forward and allow the Fed to be a little bit more dovish than it currently is positioning itself.
Greg, do you think that this is driven by the banking sector? Do you think that the ongoing turmoil that we've seen is really what could drive the much greater tightening? Or do you think that this is something that just has been in the economy for a while and we haven't been paying attention to?
Well, I think there are, as I've mentioned in the past, known unknowns. There are weaknesses in the economy. We know that sectors that are interest rate sensitive are exposed to the rapid tightening cycle that the Fed and other central banks around the world have been proceeding with. The commercial real estate sector remains one sector where there are a number of vulnerabilities. And then there are other sectors that show liquidity issues and maturity mismatch issues. The pension funds, mutual funds are examples. Then there are the unknown unknowns. What do we not know about the underlying vulnerabilities in the U.S. economy, in the financial system? And could that be something that the Fed is also observing and making its decision on Wednesday based on those unknown unknowns to the general public? That's a possibility as well.
Greg, when Chairman Powell sits in that news conference tomorrow, does he know things that we don't know?
I think that's very possible. I think we have to be careful with mind games at this stage. Remember, this started as a confidence crisis. We're still in this very fluid situation when it comes to the banking sector. So there are still a number of factors that could still play out. I don't think we're out of the woods yet, but there is certainly the possibility that Fed policymakers, the Treasury, the FDIC, and others know more information about the general state and condition of the banking sector, the financial sector, that the general public may not necessarily know. So I think that's also something to pay very close attention to. There could be more signal in the Fed's approach than just simply a 25 basis point rate hike or not. I've advised and I've suggested in the past that beyond the 25 basis point rate hike, there should potentially be a suspension of the dot plot. Forward guidance at this stage may not be that useful at all.
So you think they should reach for the pandemic playbook and just rip it up and ultimately not publish an SCP this week?
Well, I think economic conditions are so fluid and financial market conditions are so fluid that providing an estimate, a median estimate of the dot plot at this stage for the end of this year, for the end of next year, and the end of the following years is not really useful. We are in an environment where the situation is not fully resolved. We still see a lot of stress on the banking sector front. We still see a lot of pressure on some entities around the market. And we still have a lot of uncertainty as to the Fed policymaking. I think the Fed needs to really consider hard how to anchor its policymaking decisions better into an outlook rather than just focus on backward-looking data dependence. And that comes not so much via forward guidance over the next few months, but really thinking about how the outlook's likely to be going forward and how that's likely to impact its policymaking.
When you look at the two-year yield over the past couple of months, it looks like a pretty harrowing roller coaster that people have been on in terms of no landing, hard landing, no landing, hard landing. Where are we now? What is the stickiest narrative that we can hold on to that potentially could be realistic later this year?
Well, I've always pushed back against this idea of making a simple narrative out of very fickle economic data. We are in an environment where economic growth has been slowing. If you remember the end of last year, we were in an environment where final demand was close to a stall. We saw some upside surprises in economic data in the first couple of months of the year. But if you look underneath the trend and if you talk to business executives, they're all about strategic growth. That means ring fencing growth opportunities, not investing like crazy, but not retrenching, both on the CapEx front as well as on the hiring front. That points to an economy that is softening. You look on the consumer side, we're seeing some cracks in the foundation in terms of rising delinquencies, an increased burden of debt, an increased burden of inflation, and a debt servicing cost that is rising. Add to that the banking sector stress and the tightening of credit conditions. And if you look forward, that points to softening consumer spending activity, softening business investment, and all in all, softening inflation. So we are going to be in a disinflationary environment, which should allow the Fed to take its time and not necessarily continue to tighten as much as it had previously expected.
Hey, Greg, thanks for this. As always, Greg Dacker there of EY Parthenon. Thank you, sir, for joining us this morning. This is impossible. So you sit there and you acknowledge ultimately they might know things we don't know about the financial system in real time. Okay, 1, 2. And then they don't scrap. Then they ultimately scrap their forecast. Can you imagine how much people would be spooked by that if they went for that?
100%. I mean, basically, that would be them saying, we have no clue. This is a game changer. We have an idea that there's something more coming. And oh, by the way, get ready. And all of a sudden, people would price in, 200 basis points of rate cuts and go wild. I mean, honestly, at what point do people start doing that and looking around at what the next shoe to drop? I mean, honestly, can't you imagine Jay Powell coming out with sunglasses being like, no SEP, mic drop?
Yeah, I'm sure that would go down well.
I mean, the whole idea of signaling, no mind games. We all play mind games. That's been sort of the sort of parlor game.
WTI crude right now, 68.60. It's positive 1.4%. What does this mess mean ultimately for the crude market? Jeff Curry at Goldman Sachs was speaking at a conference over in Switzerland, the FT Global Commodities Summit, and he said the following: the banking crisis will eventually be bullish for oil prices because it will hit supply harder than demand. If you're wondering what he's talking about,
yes,
here's the quote. He thinks ultimately the greatest impact from the crisis will be on regional US banks, which could limit the capital available to shale drillers, which will ultimately curb crude supply in America.
Butterfly wings, I guess. I just, extrapolating out that far at this point, extrapolating to next week is a little bit hard for me right now.
To tomorrow, never mind.
Yeah,
next week, that's where I'm at. Brent crude just short of 75. Jane Foley of Rabobank's going to join us shortly. Looking forward to that. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of First Republic rallied in pre-market trading after plunging to a record low on Monday. The regional bank was up 27% at one point. Other mid-sized lenders also rose. Bloomberg's learned that JP Morgan CEO Jamie Dimon has come up with a new plan to aid First Republic. PIMCO and Invesco are among the biggest holders of the Credit Suisse bonds that have been wiped out after the takeover by UBS. PIMCO holds about $807 million of the so-called additional Tier 1 bonds. Invesco has around $370 million of them. AT1 bonds offer attractive returns in good times, but take the first hit when a bank runs into trouble. The U.S. will send another $350 million to aid to Ukraine's military. The package will include ammunition, riverboats, and other equipment. It's designed to keep Ukraine from running out of artillery shells and missiles to use against Russia. In the UK, more than half of those surveyed believe the Conservative government hasn't fixed problems caused by former Prime Minister Liz Truss's so-called mini budget. That spending plan resulted in a drop in the pound and higher mortgage rates. The survey was conducted by Delta Poll for Bloomberg News. And car sales in Europe increased for a 7th month in a row as supply chains improve. The European Automobile Manufacturers Association says registrations jumped 12% in February to just over 900,000 vehicles. Battery electric autos expanded the most, surging 34%. The UK and Spain saw significant gains, and Renault experienced the biggest year-over-year change. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The real trouble starts when the yield curve re-steepens, because that's essentially the bond market saying the Fed's going to have to be cutting here at some point, so the two-year note rallies in a way where the yield curve re-steepens. And that's exactly what's going on, right? The bond market effectively is pricing some sort of a recession at this point, and the equity market is still in denial.
The brilliant Mike Wilson of Morgan Stanley on with the team yesterday afternoon on Bloomberg Television. Lisa, you know the story. You get the inversion. That means a recession might be around the corner. You get the aggressive bull steepener. that means it might be like right here, right now.
Which is the reason why some people are saying, well, it's time to buy because it could be the bottom. I mean, that's where the bulls are coming in and saying, this could be a really optimistic story and let's buy up the small regional banks and let's go.
Hey, do you want to buy the recovery before we've seen the recession? I often ask that. What's it look like?
It's a good question. And then how much is fear of missing out really the issue? I mean, there was a story today on the Bloomberg talking about how the biggest fund managers were more concerned about missing the rally, not getting in on the bottom, than they were about losing all their money. So again, how much is this just sort of people who haven't been through a crisis before and they're training?
I've said repeatedly over the last week that there's been some great journalism around this story, particularly here at Bloomberg. Francine's really pushed this story on with Credit Suisse over the last couple of weeks. The FD did a phenomenal job over the weekend too. They've put together today a read-through of the weekend's events. And there's this quote in there from a Middle Eastern investor, and I think it's worth poring over because you and I had discussed this on Sunday evening, was the decision to wipe out AT1 and to provide some value in equity political somehow? People were asking us that question in real time on Sunday evening. And the pushback, I think, was there for all to see, that ultimately, if you were part of a $4 billion capital raise only a few months ago and then the whole bank was sold for $3 billion in a single weekend without a shareholder vote, you'd probably be unhappy and not happy about that. This was the quote in the FT. One person close to one of the three major shareholders in Credit Suisse, so read between the lines, quote, "You make fun of dictatorships and then you can change the law over the weekend. What's the difference between Saudi Arabia and Switzerland now? It's really bad." There will be consequences for this going forward. We said it 20 minutes ago. There's no free lunch whatsoever. It's not like you make a decision and this goes away. Rule of law in places like Switzerland, the European Union, the UK, the United States is really important when it comes to attracting capital. That decision over the weekend to suspend certain laws to push this through, that's not going to be taken well.
If you take it a step further, how much does that raise the cost of capital for Swiss endeavors? Full stop. Because if you cannot count on that rule of law, you're going to charge a bigger premium. The backdrop to this is Middle Eastern investors that had not invested significantly in the banking sector since 2007. How'd that go, right? So all of a sudden, single-handedly, Mohammed bin Salman of Saudi Arabia pushed for this investment right before the bank collapsed. What is the read-through in terms of the appetite to invest in global banking sectors going forward?
Particularly if this gets worse.
Exactly.
Particularly if this gets worse, and let's hope it doesn't. From New York City, good morning to you and welcome to the programme. If you're just tuning in, equity futures are positive by 0.7%. We've had one eye on First Republic for you all morning. That bank is rallying in the pre-market after getting hammered, battered on Friday and through Monday as well. We're positive by almost 22% there in the pre-market. Jane Foley joins us now, head of FX strategy at Rabobank. Jane, wonderful to catch up with you, as always. We're looking back to the ECB and thinking about what that means for the Federal Reserve. Can they take a page out of the playbook from last week?
I think they probably will. I mean, we've been through this argument in the run-up to the ECB. If they don't, will it just affect their credibility even more? They're worried about inflation. The market's given them 25 basis points anyway. It's priced in. So I think they will probably take that. But, I would agree with something that you said earlier on in your show, that the way we're looking at the transmission of monetary policy has altered. If there is a difference in the amount of credit that banks are going to lend, then the transmission of monetary policy means that there may be less need for them to hike interest rates going down, the next few months. That is something which is going to be really crucial, I think, in trying to get a read on what the Fed thinks about that. And we had those sorts of comments yesterday from Lagarde. She did say that the transmission of monetary policy may have changed, and that is part of the data that they will be looking at in the months ahead to determine how much or what they do in terms of interest rate moves from here.
So will interest rate moves, Jane, really drive the differential between the euro and the dollar, or will it be something more akin to growth, more akin to what kind of landing this will be?
I think it's all going to be in the pot together. And I think also what's there right now is just the amount of risk aversion versus risk appetite. I mean, things look much calmer today, but I think everybody is sitting on the edge of their seat wondering if this is going to hold to the end of the week. There's so many unanswered questions still about what's happened, what the implications of what did go on this weekend really do mean. And of course, in the US, we still have a bank over there which is still really struggling. And then, of course, we've got the economic data to to worry about too. So the dollar is a safe haven, but there has been so much liquidity thrown out there from the Fed that should allow the dollar to soften. It has allowed the dollar to soften relative to last week. However, the dollar isn't going to soften significantly until the market really wants to go right back into high-risk currencies, and that is not going to be imminent. So, yeah, we might have a little bit of softening on the dollar if the stock market holds up this week, but we're not going to have a big rush away from the dollar because the risk appetite has been really impacted, and it will continue to be impacted as the market considers the risks of recession.
Jane, a lot of the commentators, particularly over in Europe, say that the U.S. is separate and the U.S. is in a worse situation than Europe right now when it comes to the banking sector. There are more fragilities, especially among these regional banks, and that the European banking system is strong. All the reasons why people poured money into it earlier this year. Do you agree with that assessment, that the vulnerabilities are much greater in the U.S.?
It would appear to be that case. I mean, that certainly seems to be the case. I'm not a bank credit analyst. It's difficult for me to make my own mind about that. But from what I read, from what I can tell, that would appear to be the case. However, there are so many ifs and buts. There are so many unknowns. The situation can change really very quickly. And we've got to really assess the medium term. We've got to look at the growth projections. What happens if we have a bad winter? What happens if energy prices in Europe spike higher again? That would probably change that situation. So right now, that's how it appears. But I wouldn't be feeling, too well insulated here in Europe. There are so many headwinds here too.
Every single day since the ECB met, the euro's been stronger Thursday, Friday, Monday, again today. Jane, what's the signal from that?
Well, again, it suggests that Lagarde did a good job, the ECB did a good job in really getting across the message that we've just been talking about, that the banking sector in Europe is well capitalised and is quite liquid. I mean, our own analysts here are saying the same sort of thing. So the market is reassured. But again, not all of those uncertainties have gone away. So that's what the euro is telling us. But as much as that, the slightly softer tone of the dollar relative to a week ago is giving us the same message, is that the risk appetite has improved slightly, but there are so many uncertainties here that I wouldn't be selling the dollar heavily, given the risk of recession, given the global uncertainties, because the dollar, after all, is a safe haven because it is the currency of the global payment system. People need dollars in times of stress to pay their invoices, to pay their debts.
Yep.
And that's why it's a safe haven. And as long as these recession risks remain, it's not going to be sold off too far.
Jane, thank you. Jane Foley there of Rabobank. You just get the sense that, Lisa, everyone's struggling to make a call here off the back of all of this. Don't you feel that too?
100%. People are just basically hedging all the different sides. I totally
get it, just to be clear.
It's not about Jane. It's literally everyone. I mean, Bill Dudley, who has been so hawkish for so long, not sure. It's very difficult to make a concrete call at a time of such uncertainty. The known unknowns, the unknowns, my God, we can go to sleep. And next week, we could probably be in a completely different spot.
They're trying to navigate the psychology of the news conference tomorrow. Everyone's sitting here saying that he might know something we don't know around financial stability and a financial system. And I get it. It kind of makes sense. But at the same time, if they really did, why was he opening the door to a 50 basis point hike a couple of days before banks failed in America?
Well, Greg Deco is saying he doesn't want to play mind games. It's not a time for mind games with Jay Powell. Literally, that is what everyone is going to be doing. This is entirely about mind games. That's what we've been doing all year. And the mind has been switching and the data has been switching. And where are we now? We'll see.
The ECB was playing mind games. It's in our reporting. Essentially, in the Governing Council, they were worried about the signal it would send if they didn't hike, after essentially pre-committing to hike. There are going to be mind games on Wednesday, whether you like it or not.
They're trying to send a signal to markets. We don't know what they want to send, let alone whether they can execute it, because they've tried to send it before and they failed. But this is really the issue, is how will the market take not just whether they raise rates or not? I actually think that's probably less important than whether they indicate that they're not going to be hiking further, and what they do with the economic projections.
This is the toughest Fed decision in at least a year plus. The other ones have been easy. We need to hike 25, 50, 75, take your pick.
It was easier.
This is much, much harder now. From New York City, with equity futures positive 0.6% on the S&P, we'll catch up with Christian Muller-Glissman of Goldman Sachs up next.
I think the banking system is going to get through this.
It's a very complicated environment. I think obviously the risks to the downside have increased.
The economy doesn't tend to just slow down, in a stable way. It kind of slows down, and then at some point, it really starts to deteriorate.
I think there's one rule right now. Don't overdo things.
We'll really have to watch whether there is a next shoe to drop here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Federal Reserve has 31 hours to come up with a decision. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures positive 6 or 0.7% on the S&P 500. Lisa, what will that decision be?
Yeah, no, how will it be communicated? Because it's not just what the decision will be. It'll be all of the rhetoric around it, as well as projections, at a time where it's incredibly difficult to project out to tomorrow.
We won't hear from Chairman Powell today. We'll hear from him tomorrow. The two-day meeting starts today down in Washington, D.C. You will hear from Secretary Yellen a little bit later on this morning, the Treasury Secretary in front of the American Bankers Association. And we've got some pre-release text here, Lisa. Here's the quote. Given recent developments, I think it is important to reaffirm a broader point. Our dynamic and diverse banking system is critical to the American economy. Large banks play an important role in our economy, but so do small and mid-sized banks. Well, thank you for that. What's the policy effort?
Exactly. This is, to be clear, to the American Banking Association. So this is to a room full of smaller and medium-sized banks, just to understand the audience of it. That said, you're right. What's then the implication? Is that these regional banks are too big to fail? Is it that they are systemically important? Is it some sort of backstop to deposits? Are we talking about something greater in terms of generating greater liquidity lines, which we've seen more broadly? If that's the case, you raised this before, what's the cost to these banks and how does it change the model?
Well, it's implied if that's the case. It's implied that they are systemically important if they're too big to fail. And it's implied, therefore, that all deposits are guaranteed. However, that's not in the law. And that's the problem that Secretary Yellen has had in the past week. We understand, based on our reporting, if things get worse, they're already studying the next effort. And the next effort sounds like this, that US officials are studying ways they might temporarily expand the FDIC coverage to all deposits. Now, Lisa, one, can they actually make that happen? And two, what would need to happen for them to push through and ultimately see that materialize?
And three, and you asked this question earlier, how would that change the model of their business? And if we think about smaller and regional banks, the reason why they're crucial to the economy in the United States is because of how much of the credit they provide to small businesses, to commercial real estate operators, to individuals. If they have to pay a much greater cost of capital akin to what the bigger banks do they still provide this role? Can they still play that piece in the economy? And if they don't, who then foots the bill for this protection?
And just to be clear, some of these smaller and medium-sized banks are getting smaller, much smaller over the last week. First Republic, one of them, hammered on Friday, hammered again yesterday. It's positive about 15% right now in the pre-market. More reports again that Jamie Dimon of JP Morgan, Lisa, according to our reporter here at Bloomberg, is leading another effort to do something different to try and restore confidence in this name.
And is this because they want to make a PR move so that when they go down and face Senator Warren, they can basically say, look, we came to the rescue and we did it out of the good of our hearts? Or is this because there is a read-through to the larger banks? Meanwhile, just to give you a little bit more detail, Janet Yellen saying the U.S. will intervene if needed to protect smaller banks. To me, again, is this also Janet Yellen calling up 1-800-JAMIE Dimon and saying, come up with a solution, and this was the least painful way for him to do it?
You want the good news for UBS?
Yeah.
It took us 3 or 4 minutes before I mentioned UBS. That's the good news. The stock is up by a little more than 4%. We'll see how this goes. UBS intraday is higher by a little more than 4%. Closed high yesterday as well by about 1.26% over in Swiss trading. Let's give you a flavour of the broader price action. Equity futures right now up 0.6%. Going into that Fed decision tomorrow, yields higher up 4 basis points. Your 10-year 3.52. Your 2-year up 10 basis points. Lisa, very close to 4.1% on a 2-year. Do you know where we were at the close the last time the Fed made the decision on a 2-year? Basically where we are now.
I hate that.
Isn't that amazing?
I hate that.
Isn't that amazing?
It just absolutely erases all of the turmoil
just
that we've been living.
Massive round trip.
I know, and
if
yet
these Fed officials went into their libraries, their bunkers, and didn't log on to the Bloomberg and look at the price action or read a newspaper or watch TV, they'd come back and they'd see the 2-year and be like, nothing's happened here.
is the implication that that's what we should do? Or is the implication that perhaps it gives you a sense of just how much the price action belies, at least if you take a look at just two snapshot points, what's going on under the surface? Here's what we're watching for today. There is economic data. Does it matter? What data matters? And John, you were asking this before, right? Is it just basically bank stocks? We do get the Philadelphia Fed non-manufacturing activity at 8:30 a.m. 10 a.m. we get U.S. existing home sales. But I keep looking at all of the incoming data put together by the Atlanta Fed GDP Now forecast. And you can see that GDP is now projected to be 3.25%. We are looking at an economy that seems to be chugging along just fine. So how does the Fed look at this and put a greater priority on potential strains in the banking system, even as you have officials coming out to backstop the banking system? Today, the FOMC does begin their two-day deliberation of looking at each other and saying, I don't know, I don't know, looking at that two-year yield. I mean, honestly, I just keep thinking it looks like a roller coaster that you'd see and not want to go on. And I think that that's where we're at, which is basically just choose a direction. You could hear everybody's lack of conviction in all of their calls. And at 10 a.m., Janet Yellen delivering that keynote address that we were just talking about at the American Banking Association Washington Summit. After that, she's going to be speaking with the CEO of the association about the health of the banking system. Maybe we'll get some greater detail about what kind of backstops there are, but even more so, what the consequences are in terms of the credit impulse and the role of these banks.
She struggled last week in front of the Senate. What can she say? Is she really going to give us anything new about the policy effort in Washington?
You know, it's going to be a discussion. Is she going to be asked? That's another question.
I like your description of the Fed meeting. I don't know, do you know? I don't know, do you know? Christian Muller-Glissman might know, Managing Director for Portfolio Strategy at Goldman Sachs. Christian joins us right now. Christian, wonderful to hear from you, sir. Welcome to the programme. This came from Dario Perkins over in London this morning from TS Lombard. He said central banks are stuck between the ghosts of the 70s and their PTSD from 2008. He said, I reckon PTSD wins out. What do you reckon?
Yeah, it certainly looks like that. I mean, certainly near term. I mean, not to forget the inflation normalization progress would have been very slow anyhow. And I think to some extent, you know, we were quite confident and markets were quite confident. Inflation expectations never unanchored like they did in the 70s. And so there was this kind of calm and inflation credibility you carried on. So I think the bigger concern is really banking systemic stress again. So I would also lean towards kind of GFC type concerns dominating right now.
How do you play through the concern versus the opportunity versus saying, OK, when you smell blood in the water, sometimes it's time to pounce?
Yeah, I mean, as always, you want to see some type of overshoots. You want to see some type of asymmetry arising. And I'm not quite sure we're there yet. The challenge you had was that coming into the year, people were getting quite excited, despite the fact that you're late cycle, despite the fact that the Fed has pushed up the cost of capital materially. There was the sense that the US can deal with it. It's resilient. As you showed earlier, the spot data is still resilient. And you had China reopening, Europe having less of an energy crisis. So our risk appetite indicator went up to kind of 0.7, which is one of the higher levels. So that has now unwound. But you're not really at bearish levels. And I think what really worries me is risk premia. The rates markets are very clearly sending us a very bearish signal. Like you have the front end pricing cuts from the Fed. You have bull steepening in the 2-10s curve. All of those are signals that recession risk is being pulled forward. But if you look at risk premia, especially equity risk premia, they're quite low. So I'm not quite sure we have that type of asymmetry, that type of washout where you can really say there's a huge amount of opportunity.
What are you looking at, though, to buy if that volatility does sort of start to wash out? The European banks or the U.S. banks?
I mean, that's a quite interesting discussion because banks, there's clearly stress here and there is more overshoots in terms of valuations, in terms of credit. So I think at the margin, that is an area where you can look, but the uncertainty is huge and it's a very leveraged business model and systemic stress is kind of going in waves at this juncture. So it's a bit early. But if you ask me which banks to go for, it feels the European banks, have a slightly different setup because they have less of a liquidity problem. They had a systemic capital concern, a profitability problem. And I think that seems to have been put under control. Whereas I think from a deposit side of things, you have less pressure, you have less liquidity pressure. There's a different setup. There's not even that many money market funds in Europe where actually savers could park their cash. So it feels like there's a slightly different problem. In the US, that problem might linger a bit longer, especially if the Fed continues tightening.
Well, Christian, how much of a challenge is that bull steepener in the yield curve to the bank's call you're ultimately making?
Yeah, I mean, like, as I said, like the US banks, I don't think they're completely in the clean yet. I mean, that bull steepening, as you know, was probably exacerbated by positioning, where you had this enormous rates volatility driven by macro investors unwinding these hawkish calls into the central bank season. So we need to see where the dust settles if that bull steepening continues. It also comes from very inverted levels. We find that the risk to equities increases the more the yield curve bull steepens. So right now it's at very inverted levels, has bull steepened a bit. If that process continues, I would be careful to take any cyclical risk, and you would certainly expect equities would underperform bonds.
Do you have a base case right now, though, Christian? Because from what you're saying, it sounds like perhaps the situation in Europe might have been a head fake and you'd expect further inversion again.
Yeah, I mean, it looks a bit like that. Our base case from the economists, both in Europe and in the US, is that we're not done yet on the hiking cycles. There's this idea of separation between systemic stress and inflation fighting. And if that's true, it's a bit premature to see that bull steepening, but we have to listen to the market a bit. I think the market certainly is worried that we reached a point where central banks are constrained to hike, and where this financial conditions tightening, which has been relatively controlled for most of last year, driven by front-end rates, has become much less predictable, and a bit more uncontrollable. And that means that you have much more risk of an error. You have much more risk of, central banks having to backpedal.
Hey, Christian, thanks for that. Christian Müller-Glissman there of Goldman. Is it a head fake in Europe? Christian is talking to this bond market yield curve in Germany, and it is going the other way today. The 2-year lease is up by 20 basis points, so that curve, a little further inversion after the bull steepener we've seen ultimately worldwide. And for those of you just tuning in who might not understand all of that jargon in the bond market, ultimately that means you have different durations across the yield curve, and it's the front end, the 2-year, that's rallied harder than the rest of it, so the yield's dropped a little bit more, so the curve kind of does this.
Well, and just to put it in even simpler terms, does the ECB start to have to hike even more again when people start to worry less about banking to contagion and more about inflation?
Are we a bank solution away from this no landing stuff all over again?
And
can you imagine how much that's going to drive people nuts? James Athey of Aberdeen, he called it narrative table tennis. People, me.
Yeah, I was about to say, you're talking to me.
No one cares about me. Marvin Lowe, State Street, coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is studying ways to guarantee all bank deposits if the current crisis gets worse. That's a move sought by a coalition of banks. Bloomberg's learned the Treasury Department is looking into whether regulators have enough authority to temporarily insure deposits larger than the $250,000 limit without consent from Congress. The Federal Reserve faces a tough choice at this week's meeting of policymakers. Fed Chair Jerome Powell and his colleagues will consider whether the global banking turmoil is so concerning that an interest rate hike should be abandoned. They'll announce their decision on Wednesday. The UK, Swiss, and Norwegian central banks will also set rates this week. Joe Biden has issued the first veto of his presidency. He rejected a bill that would prevent a rule allowing retirement portfolio managers to weigh environmental, social, and governance issues in their investment decisions. So-called ESG factors, such as climate change, have grown in popularity in finance. Bloomberg has learned that Vanguard has decided to close its remaining business in China. The U.S. asset management giant has notified Beijing it will shutter its unit in Shanghai, abandoning a $3.9 trillion fund market. It's also exiting a joint venture with Ant Group. Vanguard's peers, such as BlackRock and Fidelity, are still building up their Chinese operations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
after the financial crisis, we lifted the cap on protecting deposits from 2008 till 2012. The question I have, and I'm open to it, but I want to get the facts first on what caused this. When you start raising the caps, I don't know where you top it off, 250 to 500, 500 to $1 million. You know, if you're a mid-sized bank and you've got a lot of corporate deposits, even $1 million's not going to be enough.
That last point's really important. That was Senator Mark Warner of Virginia speaking to the team on Balance of Power, 5 p.m. Eastern Time daily. Anne-Marie can promo that herself in just a moment. But Lisa, it's a really important point. Ultimately, it's not about rich individuals. This is about corporate America, who needs to have a lot of money on deposit to meet payroll.
How many small businesses are having open calls right now with all of their employees saying, here, this is where our money is. This is where we deposit. This is how we're going to get you your payroll, trying to calm some of the nerves that have really gotten afraid over time. How much is this a question not of people moving their money out of smaller accounts, but really individuals who are employed not feeling certain about their future employment and getting a paycheck from moment to moment just simply because of this question? I
think there's some real nervousness around at the moment. Some nervousness for Chairman Powell as well. What did you say? They're terrified. The Federal Reserve.
Petrified.
Petrified.
Love that.
Petrified.
No, I don't think that they're petrified.
Going through a dark room, trying to work their way around and getting punched in the face, you know, as they're doing it. Weekend after weekend, you know, just slap, bang. Futures right now, positive 0.7%. Stick that in a promo on the S&P 500. Yields up by 4 or 5 basis points. Your 10-year 353.55 on a 2-year higher by 13 basis points now. So 4.1%. I'll do this for you. I mentioned it about 10 minutes ago, but it's worth going through again. I always do this every time the Fed's meeting. I look back to where we were at the close when they last met. So that was Wednesday, February 1st. The 2-year closed at 4.1%. It's at 4.1% right now. So basically we're unmoved since the close after the Fed last met, except of course it's done all this in between.
Isn't that kind of annoying to you? Isn't it irritating?
I don't know if I choose the word annoying.
I think it just belies the drama under the surface, the sort of tumultuous moment that they have to face and then understand how to navigate. It makes it feel like they can do anything and we're going to end up back at the same place.
Well, it's been two halves to this story, right? The front half was the data. Payrolls 2 days after that, monster print. Inflation, retail sales, take your pick. Some of that continued. And then the second half to the story is the last couple of weeks, which is financial instability. Because before the financial instability, we were talking about whether it's 25 or 50, not 25 or nothing. And now all of a sudden it's 25 or nothing, and the 2 years done a complete round trip.
You know, I wonder if there's a way to also mathematically quantify it, because people are saying that if you get ongoing turmoil in the banking sector, that's equal to about 50 basis points of rate hikes. We were talking about potential for 6% Fed funds rates. So at what point is what we're seeing in the banking sector something that's going to help them get to their goals sooner, and that they don't necessarily want to completely eradicate and then stop raising rates? I mean, they're kind of in a tough spot right now.
Let's get down to D.C. Anne-Marie can join us now. AMH Secretary Yellen is going to talk in a couple of hours' time. What are you looking from her?
Well, she's really just going to signal that the United States government could take those drastic measures once again. This is the quote, Jonathan, we have from her pre-prepared remarks, which do just that. She talks about the intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. So basically what the Treasury Secretary is saying is what everyone has been thinking. Will they or wouldn't they, if there was more contagion, if we do see another smaller, mid-sized regional bank start to go under, would the regulators, would the U.S. federal government come in and potentially insure all those deposits? Now, this is something the banks is asking them to do. If this goes through Congress, it's going to take many months. But potentially Secretary Yellen coming out and giving this verbal signal, maybe the Treasury Department also thinks it could stop some of these potential outflows and exodus of deposits we are seeing.
Every representative in D.C. has a regional bank under their auspices that they're trying to protect. So how unanimous is this desire to protect some of these institutions that do play an important role in credit creation?
Well, when it comes to the FDIC, the big question in Washington is, should the cap be limitless? And also, should potentially there be a time frame on it? Potentially, you have it limitless for 2 years to get some breathing room. And there actually is some bipartisan support. The issue that this administration will have if they wanted Congress to take action is that potentially they can get it through the Senate, But then when it comes to the House, you already have House conservatives, the Freedom Caucus, coming out and saying they will not do this. They think this encourages bad behavior, and they will not sign up for this. So it'll be potentially very difficult to get this through the House. But also, this is part of the point we brought up with Senator Mark Warner yesterday. He said he wants to sit and make sure he gets all the material and details on what went wrong before they start firing off new legislation. But the issue the banks say is that we need this to stop now. For Congress, it'll likely be months, maybe years before they act. And I think what you hear from Wall Street is they want some more immediate action.
This is a difficult, really, thing to sort of tease out. But in the meantime, the immediate action has been taken by the Federal Reserve, by the FDIC, by the U.S. Treasury Department, by these bodies that have taken pretty extreme measures to make sure that none of these banks really suffer some sort of rapid demise that has a contagious effect. So what kind of scrutiny do all of these agencies bear after all of this for being able to make unilateral trillion-dollar decisions that have real policy implications?
Well, there'll be hearings, right, Lisa? And there won't be one. There'll be many hearings. The first one is going to be for the end of March, on March 29th. We already heard that from House Financial Services Chair Patrick McHenry and also the top Democrat on that board, Maxine Waters. And their first two individuals they're going to be speaking to is Martin Grunberg of the FDIC and as well as Michael Barr, the vice chair of supervision at the Fed. So they will be starting with these regulators, and then potentially they'll be going down the list to find out what exactly went wrong. But again, hearings, fact-finding, all of this will take weeks and months. And when you're talking about potentially an exodus of deposits, which is what we saw over the weekend with this coalition of banks writing a letter to regulators saying, please lift the FDIC insurance limit, they want that to be immediate.
Who wants to play debt ceiling roulette with this going on? I haven't heard it mentioned, Anne-Marie, for a couple of weeks. What's going on?
Well, no, debt ceiling discussions are still... Well, reporters are still asking about them. What you hear from both sides is that they maintain their positions. There's not a ton of communication going on for them to maybe potentially find a middle ground in this. The White House maintains that this needs to be a clean lift. And the Republicans say that they cannot do that unless there is some sort of negotiation about federal spending cuts. So we're pretty much the same place we have been for months.
MH, looking forward to the programme a little bit later, 5 p.m. Eastern Time on Bloomberg TV with Joe Matthew and Bloomberg's Anne-Marie. Nobody's talking about the debt ceiling anymore, are they, Lisa? I've not heard it mentioned at all.
And I wonder if they're actually talking about it behind closed doors or if they're just forgetting about it and going to deal with it later after this whole thing is kind of worked through. It's a real question because ostensibly it has real implications if they don't come to some sort of resolution, and there could be the threat of default. Add that to all this.
Do you remember the conversation around the idea that when we got into trouble next time, fiscal policy would be constrained, the Fed would be constrained, and how quickly everyone's already saying, no, the Fed's going to back away now, it's done. That's it, it's done.
And take it a step further, not only is it going to back away, it's also going to provide pretty intense liquidity lines to any bank that needs it. Again, has the story changed? Have we really faced something new that's really been stress tested by inflation? And are people going to wake up to that and realize that that playbook doesn't really work in the same kind of way?
Well, Chair Powell has the opportunity to set us straight tomorrow in that news conference. Lisa and I will run you through a special programme, as we often do. The Fed Decides, Bloomberg Surveillance, tomorrow afternoon. Do you want the round trip on a 2-year? The low since the Fed last met, 362.83. The high, 5.08%. And Lisa, where we are now, 4.1%. Where they were when they last met, 4.1%.
Just the volatility in the 2-year, to me, doesn't that break something in and of itself? I mean, if you think about leveraged players that are using short-term rates as some sort of borrowing mechanism, I mean, how does that play out?
Well, there's some short positions that got squeezed hard.
Exactly. So you just think,
hard.
What else is out there?
Futures up right now, up 0.8% on the S&P 500. Equities picking up here by 8 or 0.9% on the S&P 500. You'll hear from the Treasury Secretary a little bit later on this morning. We have had just a few snippets from her address. Here's one important quote for you. Our intervention was necessary to protect the broader US banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. I guess that's as close as you can come to saying, Lisa, we'll be there again if we need to be, in the same way.
We will protect all deposits, not just those up to $250,000. You raised this issue. How much is this signal to basically restore confidence without having to actually execute that backstop? Does that work? Is that enough? And really, that's what people are looking for, to sort of get a sense that all is clear.
It's the difference between being a Fed chair and I think being a Treasury Secretary. As a Fed chair, if you say something like that, I think the market adjusts to it almost immediately. As a Treasury Secretary, you're targeting not Wall Street, but ultimately the consumer. Does that restore confidence in the small and medium-sized banks? Are those words sufficient enough, or do you need to see a real rule change to restore that confidence?
It's a good question, and we're not going to know the answer right away. I mean, if I come up with an answer, it would be false, because we're going to have to see how the consumer sentiment plays out, but we also have to see what other fragilities emerge at some of these other banks that do have pretty severe mismatches of duration and deposit beta with what we're seeing in their longer-term loans that were underwritten during a very different interest rate regime.
Because, as you know, the most effective backstop is the backstop that never has to be used, right? So when you look back to President Draghi at the ECB in 2012, when he said whatever it takes, and he came up with a new program, OMT, never activated, never had to be used, because markets were like this. No, thank you. I'm not going to take the other side of that at all. I don't think you can do the same thing with words and bank deposits. I think you actually have to have a policy and establish a mechanism. So there is no backstop if all you're saying is we could do the same thing again if it poses a risk of contagion. Now, does that apply to what bank? Does that apply to the one we've been talking about over the last couple of days? Does it apply to other banks? Is it all banks? Is it all depositors? You need to be much clearer about that, I think, to satisfy some of the concerns people have.
And what is the legislative parameter they are operating under to do this? To your point, how do they codify it? One reason why people are still concerned is because this federal home loan banking system, which was really operated to protect some of the smaller and regional banks from some of the liquidity issues, has seen their loans extended climb to $1.1 trillion, this according to Barclays analysts, which exceeds what we saw in 2008. So this is basically some of the tea leaves people are looking at and saying, why do they need capital? Is it just protective measure, or is there something more going on?
Let's see if they can restore confidence. Let's hope they can. At the moment, First Republic's been rallying pretty hard in the pre-market after two tough, difficult days, 2 difficult weeks to be clear. We're up by 14% there. Lisa's going to go through the single names in just a moment. I want to get to the bond market, 2s, 10s and 30s. Your 2-year yield in Germany is up by 20 basis points. Similar move on this side of the Atlantic as well, on the 2-year in the States, up by 11 or 12 basis points. Let's call it 4.1% on a 2-year. In the FX market, euro dollar advancing for 4 straight sessions, very close to 108 now, positive 5 or 6/10%. There is a better tone in the last 30 minutes following some of these comments, Lisa. Let's be clear about that. Euro dollar 107.80 to be clear.
Yeah, and that has been something that builds already on a feeling that perhaps we're past the worst. If we take a look at some of the bank stocks, you're seeing it not only in the medium-sized banks, but also in the major banking complex of the United States and in Europe, frankly. But if you want to take a look at First Republic, those shares popping less than they were before, but up by more than 14%. Is this a feeling that the worst is in, and that some of the solutions, including the one coming up that came out of Jamie Dimon, will actually help stave off some of the distress? If you take a look at the other banks, Citi, Bank of America, as well as Wells Fargo, those shares all are recovering just a bit, again, to point to stability. I want to take a look at 2 tech stocks, some of the 2 major names, Meta and Amazon. Meta shares are rising after Morgan Stanley boosted them to overweight because of new efficiency measures, read job cuts, and those shares are up almost 3%. And the reason why I'm pointing to Amazon is because yesterday they came out and said they're going to cut 9,000 more jobs, including at AWS and Twitch, some of the more profitable areas of its business. These job cuts, they have been interesting. They have given some people hope that the big tech names will actually perform better because they've already taken some of the pain. But it raises a question of what they are seeing that has yet to play out in employment at a lot of other companies.
Meta, the year of efficiency.
Yeah.
Is that what it is? The stock's up by 64%.
It's working for them.
Investors like it.
Exactly.
In a big way.
They feel like they've moved past the highfalutin ideas that don't actually make money, and that they are moved toward a sort of more realistic model.
Or at least they're giving the idea to shareholders that they've moved past that. I'd love to ask Mark Zuckerberg himself as to whether he's actually moved past that. Maybe he's not throwing money at it, whether he's truly moved past it. I don't know. Lindsay Rosner joins us now, portfolio manager at PGIM Fixed Income. Lindsay, wonderful to catch up with you. We were lucky to catch up with your colleague, Greg Peters, on Sunday evening to talk about contingent convertibles, COCOs, AT1s, all those good things which turn out to be bad things. Lindsay, why have you managed your risk around those securities differently to maybe other shops? And I'm thinking Invesco, PIMCO, which reportedly are holding the bag on this one.
Yeah, I think Greg said it best. The documentation around these kind of instruments have been particularly murky, and we haven't felt that we needed to go further down in the capital structure to really take advantage of the banks that we like. We really like U.S. money-centered banks, particularly in the holdco paper. We think that that looks really good, and we've had a lot of opportunities with a lot of concessions in the past few months to buy banks much cheaper. Haven't needed to go into this risky thing, and obviously have been rewarded for staying away from it.
That said, Lindsay, there is a question about some of the regional banks and the credit of them and whether there needs to be some sort of premium baked in because of the potential greater risks of less regulation and more deposit beta.
I think that's absolutely true. And that's also been our thesis, that we want to be in the big U.S. money-centered banks that got all that extra regulation after 2008. The idea that these regional banks were smaller, maybe less important to the structure, I think we've all learned that is not the case. Haven't been compensated in terms of spreads and haven't gone there specifically. I think something that you just talked about earlier, which is the kind of Main Street versus Wall Street. Main Street banks at the regional banks, and I think going back to the whole idea of confidence, we have not solved that problem. There is fragility in the system, and a small business cannot operate with $250,000 at multiple regional banks. That is just not going to work. And so we very much are looking for a solution there. And it may take a while. We're hearing, obviously, that the government is studying. I was only a public policy major in college, so I don't know how long studying happens to last. But I can certainly say that small businesses are concerned. And you're actually seeing a lot of money move to money market government funds, not the prime funds. And I think that's a big heads up, that small businesses are very concerned with what's going on with regionals.
This is a reason why, Lindsay, a lot of economists are trying to game out ongoing distress in the financial system and how many rate hikes that's equivalent to, right? What kind of credit tightening that implies. Bloomberg Economics coming out with 50 basis points of a rate hike. From your vantage point, how much of a tightening feature is this? How much does this really impact credit quality that forces you to increase your expectation for credit spreads, for risks, for defaults?
Yeah, it's hard to put an exact number on it. I think we're all trying to figure out what this looks like. But absolutely, the credit box has tightened here. Lending standards are going to be much stricter going forward because you have this deposit flow. I think what's so different about the flavor of this crisis, if you want to call it that, in banking this time around is just how fast the money is and how digital it is. I mean, we can all move money in our own accounts from our phone with just a press on the screen. That was not the 2008 experience. So what we're seeing here is definitely that the risk of a recession has ticked up. It's a question of how much. Certainly, we're seeing some resolve this morning in Europe. European corporates are 20 basis points tighter this morning. Things feel better, as you mentioned. Yields kind of across the governments, whether it's in the U.S. or abroad, are higher. So there seems to be a little bit of less concern. But we've got a lot to figure out as we wait here to hear what the Fed is going to do tomorrow and what they kind of tell us they're going to do in the future.
You mentioned speed. Matt Britt of Invesco talked about that with us yesterday, and I think it's an important point. Just a reminder of how quickly some of these institutions can fail. And Lindsay, with that in mind, he pointed out that that's not the same as an industrial. That's not the same story. There should be maybe a valuation gap between these different industries now, similar to what we saw after 2008. And Lindsay, the question I asked Matt was ultimately how long that can last. How long does that take to ultimately resolve that gap that opens up between one industry and all the rest?
Yeah, there is no reason that industrials and banks have to trade on top of each other. In fact, historically, banks traded through industrials. A trade that we've really liked since last year was owning banks versus industrials because you were compensated with more spread. But I think going back to what we said in the very beginning, what is crucial is that it's what banks that you own. And so much that I think we believe in terms of active management is teasing out which balance sheets are going to do well. And I think we've just got a clear support here for the big banks. And so the big banks can rally.
Got to squeeze it in, Lindsay. You mentioned the Fed. Where are you in the team tomorrow? 25? Nothing?
We are, our base case is 25. I think that base case isn't with a major degree of confidence because there's a lot of concerns. I don't think, though, we are in the camp that if the Fed were to pause, we don't think that the suggestion there is that there is a crisis brewing and they know something that we don't know. I think you discussed this with Greg on Sunday night. Instead, if they pause, I mean, they can pause, right? They have another chance to hike 6 weeks from now. So it's not like they pause and they're never allowed to hike. They have that flexibility. That's part of their doctrine. And I think we shouldn't panic if we see them pause. Personally, I'd like them to pause. I'd like them to see some time in between for us to work out what's been happening in the banking sector. All this happened in this past week and last week, right? So we get a little bit of a breather to figure out what's going on with markets. That's just my 2 cents.
Lindsay, thanks for that. Lindsay Rosner there of PGIM. Thank you very much. Lisa, when you ask people what they think they will do versus what they think they should do, a gap opens up. A gap starts to open up.
Pretty much consistently. But I wonder if they were Fed chairs, would do the same thing that they think that the Fed will do. I mean, really, if you think this is mind-bending, honestly, I'm not going to go there. But I will just say this. The problem with waiting 6 weeks for another rate hike is that everything can change in 6 weeks. And we have seen that again and again. And suddenly we could get worried about inflation. And then all of a sudden it's another kind of error. So this is a fraught situation for them. It's not so simple. Waiting 6 weeks is very difficult in a world where people's narrative, what is it? Narrative ping pong? Is that what James Athey called it?
Yeah, narrative table tennis.
Ping pong in the
just
US.
Back and forth. Yeah, I mean, same thing.
I translate it.
Just taking his words. You know, I get
Because
it.
he's
It makes
British.
sense. I'm sure Americans understand.
Well, you know, I just want to translate it into American in case they didn't. Are you good at ping pong?
Terrible.
Really?
Absolutely terrible.
Oh, it's fun.
Highly competitive, so I don't play. Coming up.
That checks out.
Ellen Wald of the Atlantic Council. You only play things you win, Bramo.
All right, thank you.
That's
Thank
the
you.
whole point.
Life tip.
You know, that's it.
Pro tip. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of First Republic rallied in pre-market trading after plunging to a record low on Monday. The regional bank was up 27% at one point. Other mid-sized lenders also rose. Bloomberg's learned that JP Morgan CEO Jamie Dimon has come up with a new plan to aid First Republic. PIMCO and Invesco are among the biggest holders of the Credit Suisse bonds that have been wiped out after the takeover by UBS. PIMCO holds about $807 million of the so-called additional Tier 1 bonds. Invesco has around $370 million of them. AT1 bonds offer attractive returns in good times, but take a hit when a bank runs into trouble. The Prime Minister of Japan is becoming the final leader from the group of 7 nations to visit Ukraine since the Russian invasion. Fumio Kishida is meeting with Ukraine's President Volodymyr Zelensky. Japan has sent non-lethal military equipment to the Ukrainian forces. It's also imposed sanctions on Russia. In the UK, more than half of those surveys believe the Conservative government hasn't fixed problems caused by the former Prime Minister Liz Truss's so-called mini-budget. That spending plan resulted in a drop in the pound and higher mortgage rates. The survey was conducted by Delta Poll for Bloomberg News. And car sales in Europe increased for a 7th month in a row as supply chains improve. The European Automobile Manufacturers Association says registrations jumped 12% in February to just over 900,000 vehicles. Battery electric autos expanded the most, surging 34%. The UK and Spain saw significant gains, and Renault experienced the biggest year-over-year change. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There's a risk here that there's a financial crisis going on. There's a risk, a more elevated risk we slide into recession. If that happens, the Fed will ease, and the Fed will ease as much, if not more, than what the market is pricing in. But right now, I would not put that as the only scenario that can play out. And I think if we don't go into recession in the next few months, the Fed's not easing.
Bruce Kasman, just brilliant yesterday. Chief economist over at JP Morgan, looking for the Federal Reserve to make a move tomorrow potentially, and then some ums, some ahs, and some pauses in between. Who knows, Bramo? I can't get a clear answer from anyone at the moment.
As I was listening to Bruce and many other analysts, I feel like people are just coming up with all the potential outcomes and they're putting it on a big board and then they're taking a dart and just throwing it and seeing which lands most frequently on which. I mean, honestly, at this point, 25 basis points, no SEP, talking about no more rate hikes, then potentially seeing a collapse of another bank. I mean, how many parameters can you come up with to understand where we are right now?
In a little more than 2 hours, you'll hear from the Treasury Secretary, Janet Yellen. We got a release of some of her comments a little bit earlier. Here's the quote that stands out for a lot of you. And if you're just tuning in, welcome. This is what she had to say. Our intervention was necessary to protect the broader US banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. Question is, Lisa, are those words sufficient to restore confidence in a shaky system?
Lindsay Rosner said it really well. She said this doesn't solve the problem. At the end of the day, there is a mismatch and there is a much faster transmission mechanism of people withdrawing deposits from some of these banks and then a read through to what they do and whether their business model is sound. That problem has not been solved, even if they come up with lines of credit. So what is the longer term solution for this entire complex in the banking sector?
First Republic's having a better morning so far. We're up by a little more than 17% in the pre-market. There is an assumption, and we've been talking about it for at least a week now, maybe longer, that this will all lead to tighter credit standards, financial conditions, and all of the above. So what does it mean for crude? I imagine that was top of your mind. Jeff Curry of Goldman had this to say. Everyone's got a take, haven't they? Here's Jeff's. The problem is in the regional banks in the US. What kind of lending gets hit is what's going to the shale patch. So it's more of a supply hit. When we think about it further out, it's likely to be a demand hit than likely to be a demand hit. So more supply than demand. That was in the FT Global Summit, a conference on commodities over in Switzerland today.
I guess on one hand, he's correct that is the case. But what about slowdown in demand from the fact that potentially there could be also some sort of global slowdown in response to tighter credit conditions? What about what the OPEC response is? I mean, it's just honestly trying to get oil right is as easy as it is to get Jay Powell right.
So, Ellen, it's your turn. Ellen Wald joins us now, Senior Fellow at the Atlantic Council. Ellen, can you tell us how important it is, how dependent shale producers are on regional banks in America?
Well, I'm not going to totally speculate on just how dependent they are, but I'm going to guess that a lot of them have actually probably reduced some of the exposure that they might ordinarily have been facing, given the fact that for some time now we've seen lenders tightening and not, shelling out capital to oil producers. This is an industry that's gone through a huge amount of consolidation over the past, decade, essentially, or a little less than a decade. And so I'd venture that they're probably not quite as exposed as, say, some of the startups in the Silicon Valley area are. My concern is definitely on the demand side and the supply side. It's a very interesting crisis because we're not really seeing that much in terms of a change in the supply demand forecast, but prices have moved substantially and forecasts for prices are also on the move.
Talking about the read-through from the banking crisis, I'll give you another perhaps somewhat fantastical scenario. What happens if the Middle East investors that lost money in some of these banking issues, I'm thinking of Mohammed bin Salman and Saudi Arabia, suddenly want prices to be higher? If they've lost money in markets this year, what if they actually don't want to produce more oil because they want prices to go up? How much is that a feature in the OPEC response mechanism to all this?
I would say that's definitely of concern. I think that OPEC definitely, or at least Saudi Arabia, has a particular range that they like to see prices in. And I do think that triple digits to them are too high because that then threatens them on the demand side. So, if prices hit 80 this summer, I think that that's still in a good range for them, and they're not going to be making any kinds of supply cuts. Now, if we see a sudden drop in oil prices due to, say, a major major global financial crisis, then we should definitely look for OPEC to act just like they did in 2008 to kind of protect oil prices. What I think is more interesting here is they definitely see this, and they came out with some comments last week that, this is mostly a financial issue. They don't see it as a supply-demand issue. So how would changing supply and demand impact the market? What I see as an interesting potential, though, is the U.S. has a potential to impact the demand side, because we've got the U.S. government having said that once oil gets to a certain range, they want to rebuy for the SPR. Could you imagine what a major influx of demand from the U.S. government could do to oil prices right now? It would essentially be saying, here's a huge surge in demand that we weren't necessarily expecting. And we are in a situation where supply-demand is pretty tight, or at least expected to be pretty tight. And that could definitely be a factor that could push oil prices up if, nothing else is.
And I'm really happy that Lisa brought up the Middle East, because we talked about a quote in the Financial Times this morning. I'm going to share that quote with you. Ultimately, the FT put together this wonderful story of developments over the weekend to secure that deal between UBS and Credit Suisse. And the Saudis have been burnt. Let's be clear about that. They were the top shareholder, Saudi National Bank. This is the quote in the story. According to one person close to one of the three major shareholders of Credit Suisse, you make fun of dictatorships and then you can change the law over the weekend. What's the difference between Saudi Arabia and Switzerland now? It's really bad. You know about the kingdom. You wrote the book. How do you think this might change investment decisions from Saudi Arabia?
Yeah, that's a very interesting perspective. And I definitely think that the idea of changing the law over the weekend is absolutely something that we see, that we expect to come from a dictatorship. We don't expect, this is a monarchy. They don't really run by rule of law. They generally, I think, because they want to be seen as a stable force and they want to be seen like other Western economies, tend to try to adhere to kind of global principles. But when it comes down to it, they're not. They don't have to go through any kind of, real legal processes. And I think that if the Saudi government or the Saudi royal family is hurting for money due to, investments or particularly bad investments, I definitely think that you could look to see them potentially try to recoup that from what really is the Saudi cash cow, Aramco. Aramco had a banner year. They're flush with cash. And would you really be surprised to see if the, Saudis try to, or the royal family or the government try to kind of raise their, their dividend or whatnot from the company in order to make up for a potential shortfall caused by some bad investments?
Ellen, just real quick here, 30 seconds. Is there another implication in terms of what Saudi Arabia is willing to invest in globally as they try to diversify away from just oil streams of revenue?
Yeah, I think that they're investing all over the place, and I don't think that this is going to stop them. In fact, I think that this probably speaks to the fact that they need more diversity, and they feel like they've got a lot of cash and they want to invest it.
Ellen, thanks for joining us. As always, Ellen Wald there, the brilliant Ellen Wald of the Atlantic Council on the situation with Saudi Arabia, banks and crude. Joining the dots, Bramo, from one thing to another.
This is fascinating to me because this was the money that kept Credit Suisse afloat. So if you think about what that means at a time when potentially they're getting some money before the AT1 holders get any money, and does that get unwound? Does it get to be a lawsuit? What do they do in terms of other further investments going forward? There are a lot of real questions here about the rule of law in the banking center of the globe at a time when it seems to have been upended over the past couple of weeks.
Undermining rule of law in the West is an important development. Be really, really clear about that. Rule of law is what attracts money from places like the Middle East. That's why they buy houses. It's why they buy mega mansions in the City of London. It's because they know it's not just going to disappear overnight. You're not going to have a shakedown at the Ritz like they did in their own country. Changing the rules just like that over the weekend in Switzerland, I don't think we have fully realised or even recognised what the consequences might be.
One distressed debt investor said what he looks for when he looks for where to invest is their contracts and how well they hold up.
And can you trust them?
Can you trust them?
Futures right now on the S&P positive 0.9%. Imagine that you're a shareholder and you just get no say in the deal whatsoever. From New York City, this is Bloomberg.
The developments in the banks over the last couple of weeks have probably pulled forward those recession probabilities somewhat.
These are sound financial institutions, but if there's no confidence, then there's no ability to have a foundation there.
Inflation is coming down this year, but it is not going to be sufficient to be satisfactory to the Fed.
I'm assuming that the Fed goes 25 bips on Wednesday. It's 25 and done.
The number one rule in restoring confidence is steady hand, steady ship. Don't overdo it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This central bank is about to confront its toughest meeting of this whole hiking cycle of the last 12 months. From New York City this morning, good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Equity futures with a lift here up 8 or 0.9%. A better tone to this market after these headlines dropped from Secretary Yellen of the Treasury. She'll be speaking in about 2 hours from now. This is what she had to say, Lisa. Our intervention was necessary to protect the broader US banking system, and similar actions would be warranted, could be warranted, if smaller institutions suffer deposit runs that pose the risk of contagion. Is that sufficient?
Well, let's see, because it has to play out throughout the day, and we have to see some evidence that these banks are stabilizing in terms of deposits and in terms of just consumer confidence. That said, how much does this really avoid, A, bigger legislative changes, and B, some more credit distress that people have been talking about with increased credit tightening on the part of some of these smaller and regional banks?
So let's stay on the story. First Republic is up by, let's call it 15, 20%. There and thereabouts. That's the range of the last couple of hours or so. Again, the news suggesting that Jamie Dimon of JP Morgan is leading some kind of effort to support this lender. Seemingly the effort last week, insufficient. 11 banks, 30 billion on deposit, not enough. What's next?
Well, do they need a what's next, right? So the thinking, I think, from some of these big banks, at least as it was reported, was that $30 billion didn't really move the needle in terms of the overall deposits at the bank. But if you infuse that with capital, if you make that just a capital infusion instead, it will go further. And I think that that's perhaps what people are seeing. I don't know. Can you read anything into any of these moves in terms of who's doing the trading and what they're trading on and how much money under the hood is actually moving around in terms of deposits outside? We heard Gerard Cassidy yesterday saying they're not really seeing that many deposit outflows and they're not really tightening credit conditions all that much. So how do you get your head around the story?
We explored this through this morning. What's so important about this bank? Why is it this bank that Wall Street's coalescing around to support? What is it about this bank?
Is it the fact that it is a major commercial real estate lender? Is it the fact that the clients are perhaps overlapping between that bank and some of their banks? Or is it just the perception? I don't know the answer. But I will say this. We have redefined systemically important. That has been the takeaway over the past few weeks. We have redefined systemically important to indicate which banks potentially are systemically important for specific industries that they are significantly lending in. This is a new definition, and it will require some policy changes.
Well, systemically important to many people used to be big names we all know. I'm not sure things like Signature Bank were part of that view. Were they?
They were decidedly not part of that view, I think is fair to say.
Or SVB, for that matter.
Correct. So then to hear the Swiss National Bank saying, Silicon Valley Bank, why did you take down Credit Suisse?
Crazy, right?
And then to have all of a sudden people around the globe pointing to this bank in Silicon Valley that really isn't a normal traditional bank of a region, but much more of a driver of loans to Silicon Valley companies, to startups, tells you where we are.
Policymakers in the US are doing the prudent thing, preparing for the worst. That's what you do. One plan might be, and they're studying ways to do this, according to our reporting, studying ways that they might temporarily expand the FDIC coverage to all deposits. I just wonder what the trigger would be and how close we are to that moment.
And how much that would change the business model. You mentioned this earlier. I really want to stick to that because at a certain point, people are going to say, who's holding the bill? If this bank makes irresponsible decisions, is it the taxpayers?
They'll work very hard to make this business much less profitable if that's the road they go down.
Which
You'd expect
means
regulators to go down that road.
Which means that they're going to do a lot less of some of the credit lending that they've been doing that big banks don't do because it isn't as profitable because money is more expensive for them.
So you end up full circle then, tougher growth profile. Is
Correct.
that the take, ultimately?
I don't see a way for that not to be the takeaway here. How can these banks lend in the same way? And I'll tell you just a little anecdote. Alex Tanzi of Bloomberg put this out, that a Federal Reserve survey of consumer expectations shows that auto loans that were denied rose to the highest percentage of overall applications going back to 2017, rising substantially in the latest survey. There's credit tightening that's ongoing, and it probably will continue.
I wonder how many of the big banks start just saying, no more accounts. No, thank you.
Where do they go?
Not opening anymore. Do you think they want all these deposits?
Definitely not. Absolutely not, because that means that they have to hedge against it and have the reserves, and it becomes costly. But you're right. I mean, what then happens?
Let's get into the price action. Equity futures right now, session highs, up 0.9% on the S&P 500. If you're following First Republic, battered on Friday, pummeled on Monday, bouncing back on Tuesday. It's a nice bedtime story,
that was beautiful.
Isn't it? Yeah, I'm sure that helps.
Battered,
and that helps the equity bulls sleep at night, no doubt. First Republic right now up 21%, let's call it 1473. Not lost on many of you that a couple of weeks ago this was a triple-digit name. It's now holding on to double digits at just short of 15 at 1475. Joining us now is Marvin Lowe, the Senior Global Macro Strategist at State Street. Marvin, I'm going through the calls for tomorrow, and good morning to you, sir. Welcome to the programme. And the calls are basically for 25 basis point hikes. There is a call for a pause in there from the likes of Goldman, the likes of Barclays, Credit Suisse even, the likes of Wells Fargo looking for a pause. Nomura's got a cut in there. And Marvin, not for you to speak for Nomura, but I just wonder what would need to happen between now and 2 p.m. tomorrow for this Federal Reserve to cut rates?
Well, remember a couple of weeks ago we were debating whether or not they were going to go 50 and how much higher they were going to put the dots in terms of terminal expectations. So for us to go to solidly 25, potentially nothing, and then a cut is completely based on systemic risk. And that view that a cut might evolve, I think, requires the systemic risk type of concerns that we've seen calm down a little bit over the course of the last day or two, come back with a vengeance. So, you mentioned the market's focus on some of the larger regional banks that are out there that are under pressure. For sure, those types of situations would need to get much worse for us to get a cut, in my view at least.
One of my favorite parlor games of 2023 has been not only tell me what the Fed is going to do, but tell me how the market's going to react. Let's say the Fed does raise rates by 25 basis points tomorrow. How does the market react?
You know what? I think that it's going to take it, it's more than just the 25. It's going to be signaling around what it expects afterwards. If it is a dovish hike the way it seems to be building as a consensus, I think the market takes that as risk on to a certain degree, because we've taken out the 6%, 6+% type of tail risk that we were talking about, again, just 2 weeks ago, amazingly. And now we're wondering, okay, can they even hike this meeting? So that in and of itself is much more dovish than where we were a few weeks ago. And it gives us a much better sense of when they're going to stop. We either generally thought that they were going to be done by the May meeting, possibly by the June meeting, but we weren't sure. Now I think if they do a dovish hike, you get really comfortable that they're going to be done hiking sometime within the next 6 to 12 weeks at the most.
So does that make you excited about risk? I mean, if we move past this narrative that if the Fed becomes less aggressive, that you can just go full tilt into equities?
You know, you and I, Lisa, have talked about this often. The problem is that valuations don't really make that possible. It's a real challenge when valuations continue to remain expensive. And I don't think we should lose sight of the reason that we're able to pivot. Ultimately, as you mentioned, recession odds have increased. Credit tightening is something that I really expect. I don't see how banks ultimately go back to lending the way they did. That in and of itself is a bigger challenge for the economy. So no, I don't think it's risk on. I do think it focuses maybe investments around a greater recessionary odd where you can expect the Fed to possibly start to cut next year. And, position your portfolio for those types of scenarios.
Marvin, typically then, when the curve starts to anticipate that and bull steepens in the way it has done aggressively in the last couple of weeks, where do you want to be in the equity market with that playing out?
Yeah, I still think if we are talking about a recession and we're talking about tighter credit conditions, I think you still look for stronger companies. I mean, we always want to own the best companies in our portfolio. I think quality growth has been something that I've held on to. I think financials have always been challenged with this part of the cycle, and it's a parsing of the sectors around that viewpoint.
Is the Nasdaq 100 quality growth?
You know what? For the moment, it is. I think that we have the opportunity to look a little bit deeper in it and really decide which parts of that we really want.
Interesting. Marvin Loeb of State Street. Marvin, thank you. Looking ahead to the Fed tomorrow, potentially going 25. Consensus still is 25. But as Marvin pointed out 2 weeks ago, this conversation was exceptionally different. It was 25 or 50, and maybe 50 if the data came in line with expectations, and it did. And now it's not 50, it's 25 or nothing because of the financial instability of the last couple of weeks. The Nasdaq Composite's up almost 12% year to date.
Is it because of the rate story, or is it because of the job cut story and the efficiency story that a number of these big tech companies have really put out there? I mean, I think about Amazon cutting another 9,000 employees. We talk about Apple, why they haven't done any mass layoffs, but they're doing more efficiencies and sort of trying to reduce costs. That really is the theme. And you wonder how specific, I don't want to use the I word, but specific that is to
idiosyncratic.
I didn't want to use it. Don't put that on me.
You basically did.
I didn't say it. But, you know, how much it's a specific story to the tech sector.
Do you remember the start of the year? Rate cuts and recession. And then it was economic boom and monster hikes and maybe 6% on Fed funds. And now it's rate cuts and recession and throw in some bank failures. We're not even through Q1 yet.
I feel like this is like...
We're still in the first quarter.
Narrative war stories as we try to work out just the head spinning. I do like that idea, narrative table tennis.
Where are we going to be in 2 weeks?
I mean, we'll be back where we are right now, but just, you know, where we are going to be in between. I don't know. Let's see.
Equity futures session highs up 0.9%. Dean Mackey, chief economist at Point 72, is going to be joining us in about 18 minutes' time. Equities doing okay.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says the U.S. will intervene if needed to protect depositors at smaller banks. Yellen speaks to an American Bankers Association conference today. In prepared remarks, Yellen says the government's recent intervention was necessary to protect the country's banking system and that similar action could be warranted if there's a run on smaller banks. The Federal Reserve faces a tough choice at this week's meeting of policymakers. Fed Chair Jerome Powell and his colleagues will consider whether the global banking turmoil is so concerning that an interest rate hike should be abandoned. They'll announce their decision on Wednesday. The UK, Swiss, Norwegian central banks will also set their rates this week. Joe Biden has issued the first veto of his presidency. He rejected a bill that would prevent a rule allowing retirement portfolio managers to weigh environmental, social, and governance issues in their investment decisions. So-called ESG factors such as climate change have grown in popularity in finance. The U.S. will send another $350 million in aid to Ukraine's military. The package will include ammunition, riverboats, and other equipment. It's designed to keep Ukraine from running out of artillery shells and missiles to use against Russia. And the most expensive city in the world for business travel? Yes, it's still New York. According to consulting firm ECA International, it will cost you $796 a day if you're in New York for a business trip. That includes 4-star hotels, meals, taxis, drinks, and incidentals. The next 4 cities on the list: Geneva, Washington, D.C., Zurich, and San Francisco. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I'm afraid that the regional banks in the U.S., of course, are still very, very sensitive to this crisis in confidence, frankly. The state regulators are the ones that have to be empowered, and the banks should be required to disclose more about their liquidity, their capital, their other kinds of risks, such as leverage, the concentration.
It is truly a crisis of confidence. That was Myra Rodriguez Valadares, the managing principal at MRV Associates. Coming into today's session highs on the S&P 500 right now. Equity futures doing nicely, up 0.8% on the S&P 500. Quick snapshot of the market for you. Yields higher by 7 or 8 basis points, 356 on a 2-year, up by 15 basis points now. 4.13% going into the Fed tomorrow. The two-day central bank meeting begins today. If you want a quick look at First Republic, FRC, that name doing okay in the pre-market, up by 23%. Not doing okay the last few days, last few weeks. Let's be clear about that. I keep saying it. Triple-digit stock 2 weeks ago, now just about double digits. Secretary Yellen of the Treasury, she'll be speaking in about an hour and 40 minutes. Here's the quote from her remarks that we're expecting for her to deliver. Our intervention was necessary to protect the broader US banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. Lisa, as soon as that came out, we both said, is that sufficient? What's the policy backup, the follow-through that's going to come off the back of those comments?
Well, it's sufficient if you take a look at very early trading of certain bank stocks of medium-sized banks, and that's, I guess, what people are looking toward, right? I mean, you said this is basically one of the indicators that probably Federal Reserve officials are looking for today. They're parsing through the tea leaves of bank stocks.
Not the economic data, it's
exactly,
the bank stocks.
Exactly. So we're seeing right now, Western Alliance shares up about 7%. You're seeing PacWest also seeing a pretty big pop. So some of these other regionals that have been under pressure, getting a bit of a lift. Is it enough to be sustainable? Who knows? We don't even know what the problem is, though.
What is the problem?
It's that deposits can leave quickly and that they're invested in things that are rate sensitive and that possibly they haven't hedged sufficiently against that. So how do you solve that issue? And we don't know how deep that goes.
We don't. Does the Fed know? When they sit around the table today, do you think they know how deep this goes?
You raised the question. Didn't they have any indication of that before Fed Chair Jay Powell got before Congress and said, I don't know, 50 basis points seems like it's possible?
It's kind of remarkable that he opened the door to 50 basis points and we had bank failures 2 days later. Isn't that kind of crazy?
It raises a question of how much more intel do they actually have and how much did they understand the imminence of this kind of collapse?
That's the first question for Sri Natarajan of Bloomberg. He joins us now. What does the Fed know that that's not the first question? The United States, we understand, is actually studying the option of insuring all deposits, an emergency option. So I guess my question would be, do you have any clarity, Sri, whatsoever on what it would take to trigger that option?
So that's the important part here, the emergency option, because all the color that we are getting from our sources is right now the mood in the Biden administration, at the White House, the Treasury, everywhere else is such a measure is not required. They're hoping that the steps that they've already taken should be good enough to stabilize the market. May not be reflected in bank stocks just yet, especially the smaller bank stocks, but they're hoping that with deposit outflows moderating, stabilizing, and perhaps even reversing, they will not need to take a drastic measure. However, the importance of being able to say that they are studying this option tells you that they have not drawn a line in the sand. They are not saying that we will not go to that extreme. And that's very clear from Secretary Yellen's comments this morning, where she's pretty much taken a leaf out of Mario Draghi's playbook of whatever it takes.
Things felt bad last week, but we didn't really know the numbers around Credit Suisse, and it turned out to be 10 billion a day. 10 billion a day.
That's what people said later in the week.
Crazy. Do we have any idea what the numbers are now for some of these regional banks?
All that we've heard from a lot of these banks, everyone is acknowledging that they had seen a lot of deposit flight, but that has slowed down. We're not getting specific numbers. There is a little bit of a call for a lot more of these banks to come out and give us numbers, but it's unclear if that necessarily helps. Just look back to what happened on the day the biggest banks in the country injected $30 billion of deposits into First Republic. Everyone thought, great move, show of confidence, show of strength. Yet when First Republic came out with a statement and detailed some of the steps that they have taken in the preceding week, that did not instill confidence in the market. And that's why you have a bank stock that's now down 90% since the start of the month. And that bank might actually be the key to what next steps the government might have to take. Everyone that we have spoken with has basically said the next few days are critical because you'll see some sort of resolution to Silicon Valley Bank, Signature Bank. But more importantly, what happens with First Republic? Is there a solution? Is there a government-backed solution, a solution without government but just private capital? Can they stabilize the situation there? That will give us a path forward.
There's a different type of regional bank from those that serve the mom and pop investors, the mom and pop shop owners in a community versus something that has much more concentrated lending in specific industries, whether it's home lending, whether it's commercial real estate, whether it's a specific type of startup. Do we have a sense of how many banks are that exposed are that sort of dominant in specific industries?
I had a very interesting conversation with a senior banker yesterday who pointed out banks number 1 to 12 in the U.S., you don't have to worry about that much. Banks 300 to 600, perhaps not that much again. But it's sort of in the bank number 20 to 50, 30 to 60 is where some of the fears might be. How many news-focused, not confident enough customers exist at those banks that want to go in there, pull out their money, yank their deposit, and place it at a bigger bank? That's where the critical aspect lies. And even as we look at the landscape, it does feel, in talking to people in the industry and talking to people in government, that they are looking at a group of a few banks that perhaps still are problem children. They want to make sure that it doesn't spread to them and they don't also start to teeter and topple.
Isn't the only way that this really ends consolidation at the top? The bigger banks get bigger, that we end up seeing that kind of roll up in a massive way that will only continue?
And what an extraordinary turnaround that would be, because the standing posture for the last decade or more has been we cannot afford to have the big banks get bigger. In fact, if anything, we've seen calls to break up the big banks. They've become way too big. So if the solution from this point on is for them to get bigger, that certainly isn't something anyone would have been expecting heading into 2023.
For Bank of America, for JP Morgan, there was this hope for the big banks that ultimately this pass-through from Fed funds to deposits would happen. Do these guys need to put up rates to attract deposits when everyone's just throwing money at them right now?
I went back and looked at some of the transcripts from the earnings calls in January, some of the conference appearances from some of the senior bank executives, and there you could actually sense that they were talking about the need to fight for deposits. Bank of America in Q4 actually had seen $8 billion of deposit outflows. They said that we will have to work harder to attract deposits. Yet, when Silicon Valley Bank collapsed, in the following 3 to 4 days, Bank of America alone had $15 billion in deposit inflows. So yeah, maybe they don't have to work that hard anymore.
So what does that tell you about what profits might look like? I'm already looking ahead to earnings season for Q1 for these names. I'm sure you are too with the team. What are you thinking that's going to look like?
It's not Q1 that we're most concerned about. It's Q2, 3, and 4. Where is that net interest margin? Is there scope for expansion, or does that start to contract? That's what everyone is paying attention to, and that will be a tricky figure.
Concerned about or excited about? I think that that's the key question, because if they don't have to pay anything for their deposits and they can lend to all sorts of people who need money suddenly.
You've got to be very careful if you're excited in a moment like this one, not to sound excited in a moment like this one.
That's true. That's probably why they want to be.
Call. It's a difficult time, and then the numbers don't speak to it, and you're like, it's a difficult time. And just keep repeating this, a difficult time.
You sound jaded.
You've got full faith in the financial system.
Yeah, and they want to be the backstop for it.
Totally.
Difficult time.
We're in it together.
Yeah, exactly.
Difficult time. Sri, thank you. Good to see you. Great reporting, by the way. Fantastic. Sri Nandarajan there of Bloomberg on the latest. Let's get you the latest on this market going into the open in about an hour and 5 minutes from now. Equity futures on the S&P 500 near session highs and elevated through the last 90 minutes or so, up by 0.8% on the S&P. Coming up in the next hour on Bloomberg TV, Matt Miskin of John Hancock, Peter Cecchini of Exonic, and Cameron Dawson of New Edge Wealth. We'll catch up with the three of them around the open about, Lisa, in about an hour.
And then that's on to tomorrow. Are you excited for the Fed decides?
Can't wait.
Yeah? You think it's going to be exciting? Going to parse through the body language, how he does his hair tomorrow morning?
I don't know how you put out the summary of economic projections tomorrow in a moment like this one.
I want to see the press conference, what questions he's asked, how he reads from the document in front of him.
Lagarde was very close to the script.
Yes.
I imagine he might be too, because we know what happens when he goes off script.
Welcome back. This is Bloomberg Surveillance. John Ferro is off to his next property. Tom Keene is off on vacation. I'm here. I'm alongside Michael McKee, who's going to break down some economic data that no one's going to really look at because everyone's just watching bank stocks. And if you take a look at bank stocks, you are seeing a pop, especially after Janet Yellen's published comments that she plans to deliver around 10 a.m. today, talking about a backstop for banks, that these smaller and regional banks are important and they plan to do more. You are seeing a lift in S&P futures up 0.8%. %, 4,015. You could see a bit of stability across the board, if you can call it that. And frankly, I've been watching two-year yields, which have been all over the place. I mean, it really has been a bouncy ride over the past 3 months. And now we are back to the same place that we were the last time the Federal Reserve met. If you take a look at some of the banks, it is interesting to see that some of the other regionals are also seeing a pop. PacWest, we're also seeing Western Alliance getting a bit of a lift. Right now, with that economic data that you've all been on the edges of your seats for, here's our own Michael McKee.
Well, Lisa, the Philadelphia Fed non-manufacturing index, this may be the first time we ever reported it on the air, minus 12.8. That's a decline from positive 3.2 in the month of February. Don't know exactly what it means other than service industries in the Philadelphia Fed district not doing as well as they were a month ago. But as you said, this is something that will not influence the Fed's decision tomorrow.
All right.
And nor will it enter Wall Street
Okay.
because everybody's watching, as you say, bank stocks.
All right. So this is actually an important question, not necessarily about the Philadelphia Fed non-manufacturing index, which we don't really care about, although I'm sure a lot of people do care about it on the peripheries to get an understanding of different regions. Does economic data matter?
No, not to this meeting because the data are backward looking and the Fed is looking right now on a forward basis as what's happening with the banking system. They are looking at the incoming inflation data, of course, and that is why most economists at this point still expect a 25 basis point move, especially when we see some healing in the bank stocks. Now, obviously, they were all green in the pre-market yesterday, and then some of them finished down by the end of the day. But we have this potential rescue agreement, and obviously the Treasury Department wanted to get Yellen's comments out before the market opened because her speech isn't even until 10, but they put out that part of it that they might rescue other people because they want to give the idea that they're going to backstop and that everything's okay. And in that case, if the Fed buys that, then there's no reason they shouldn't do the 25 because the inflation problem is still there. That hasn't gone away.
Well, and that's actually the reason why, to be fair, I am looking at the 10 a.m. data on home sales and this idea of, do you start to see that ongoing rebound in the housing market on the lower mortgage rates that we've gotten, on the skittishness around the banking industry? I mean, honestly, this is very circular, but what we're seeing right now is potential resurgence in activity in areas that were the most interest rate sensitive as people price in lower rates. How much are you watching that kind of indicator to understand the momentum behind some of the economic growth?
Well, again, to repeat something we've said many, many times, this is a weird period coming out of the pandemic, and it doesn't really fit our models for what's happened in the past because real estate should be hit. But Americans are still buying houses. Builders are still putting holes in the ground out there. And as you mentioned, we've seen mortgage rates come down a little bit. If that continues, then you're going to have another question about home prices and whether home prices start going up because there's not a lot of availability. Excuse me. This is just about to be the spring selling season.
Right.
So do people say, well, maybe I can sell my house? That's going to be an interesting open question for the Fed because this is all going to happen at a time when we're expecting the housing part of the CPI and PCE to start to decline a little bit.
Michael McKee, stay close. Thank you so much for that. But let's really get into how we can understand the trajectory of inflation and how big of a battle it's going to be for the Federal Reserve, even as they have an eye toward the banks. Dean Mackey joining us right now, chief U.S. economist at Point 72. Dean, what's your take on that? How do you understand the inflationary impulse and how much it's actually been dampened?
Well, I think the recent data have suggested that inflation is not coming down as fast as the previous data might have suggested. And this does interfere with the Fed's narrative that we're headed down in a steady way down to 3.5% on core PCE by the end of the year and even lower after that. The recent data just don't show much slowing. And I do think that is important to the Fed's decision this week.
So what does that mean in terms of them having to raise rates by 25 basis points and that should be digestible for the markets?
I do think it's that the Fed is likely to raise rates by 25 basis points this week. The data certainly point in that direction, whether it's the very strong employment data, the inflation data that's come out less favorable for the Fed than expected. And actually, GDP growth is picking up in the first quarter. It's not slowing down the way many had been expecting. So the economic data are telling us very clearly that the Fed should be continuing to raise rates. Now, there's other factors the Fed's worried about, but I think that's what's going to be the dominant force for the Fed. They think they have other tools to address banking system issues and problems at the banks, and that monetary policy should be aimed at getting inflation back to target.
You know, my favorite thing about this moment, Dean, is that you have 5 guests on. They all say something completely different and then say you're looking at the wrong data. And some people will come on and they'll say, OK, sure, that backward-looking data shows resilience and a sense of inflation that hasn't died down nearly enough. And other people say, yeah, you got to keep looking at that because it's been right. So where do you sort of make the argument that you have to consider this data that may be backward-looking but really gives you some clean sense of where we are now?
Well, I think the data tells us where we were coming into this past 2 weeks. And where we were is an economy that was growing at a pretty strong rate, the unemployment rate very low, and inflation way above what the Fed wants it to be. Now, the Fed has to think about, does the last 2 weeks' events mean that the data don't matter anymore? I think it's too strong to say that. I think the Fed will be thinking about how much credit tightening is going to be happening as a result of the problems at the banks. But unless the Fed is convinced that there's going to be a sudden and severe stop in credit, that means no further rate hikes are required. I think the Fed will go ahead with their steady rate hikes this week.
Some people argue that de facto there will be a credit tightening by some of these medium-sized banks that are going to restrict who they loan to and how much they lend. You make an argument that that doesn't necessarily mean some sort of sudden curtailing of economic activity. Can you elaborate on why that's an important realization to inform what the Fed has to do and respond?
Well, I think, one has to think about what's happening at the banks. The very large banks don't seem to be having a problem with extending credit at this time, at least in a way that would cause a sudden stop in credit. There is credit tightening in general going on like there usually is in a Fed tightening cycle. At small and medium-sized banks, the real question is, does the typical small and medium-sized bank out there have a severe deposit outflow right now that's going to cause them to say, we're not making more loans at all? That would be what a severe and sudden stop in credit would look like. And that would, in a sense, cause the Fed to immediately stop tightening if that became apparent. My perception, from various things is that that's not happening right now. It certainly is happening at some of the troubled banks, but most medium and small sized banks do not have severe deposit outflow problems right now. And therefore, they are likely to continue to make some credit available to businesses and households. If that's right, then there is more of a gradual credit tightening process underway rather than a severe and sudden stop.
So how far away are we from going back to a no landing discussion or going back to this idea that we could just softly glide path lower, regardless of some of the recent troubles that we've seen at banks?
I think that's something that we'll be sorting out in the coming weeks. If I'm right that this is more of a gradual credit tightening process, then the very strong economic data that we've been seeing does continue to matter. And this will be a headwind against that strength in the data. And I do think there are some forces pushing the economy forward that are underappreciated, like the continued normalization of the service sector, which continues to add jobs at a tremendous pace every month. And also, I think the strength of the consumer matters here as well. If those matter in terms of the momentum of the economy, the credit tightening is pushing against that. And what we'll be trying to do is weigh those two opposing forces going forward.
So what do you make of this narrative table tennis, as James Athey put it? I mean, what do you make of this idea that people are just basically turning themselves in circles, trying to understand the moment-to-moment gyrations in a market that is more volatile than it's been for decades?
I mean, to me, it just reflects the difficulty of the situation. We're dealing with an unknowable amount of financial stress. How bad is it going to get in the next 2 weeks? How bad is the credit tightening that results from this financial stress going to be? These are very difficult things, and markets are struggling to figure it out. So we all have our own individual views on things, but the market's kind of bouncing back and forth, trying to figure out which narrative is correct.
One of the biggest issues, Dean, and I'd love to get your thoughts before we have to go, about the longer-term trajectory of inflation. This question of, are we heading back to a 2% inflation kind of reality, which is really what the market is pricing in if you take a look at the 5- and 10-year inflation expectations? Or are we heading into something where this Federal Reserve will tolerate a much higher pace of inflation to avoid some of the disruptions that we've seen in the banking sector?
I mean, I think that's one of the reasons why this week will be an important signal from the Fed. If the Fed is actually putting inflation front and center, I think it is important for them to continue to tighten conditions and signal that that is our main focus at this point. If the Fed does seem to be distracted and focused more on other issues than inflation, then I do think this impression that the Fed is going to allow inflation to persistently run above target will gain traction.
Dean Maki of Point 72, thank you so much. Really important point there, especially given that so far inflation expectations have remained pretty contained. There has not been this runaway fear that people refer back to from the 1970s. Right now, you are seeing a lift, and it is interesting to see the nature of the lift. We are seeing it in a broad-based way with big banks and small banks both getting some reprieves from some of the comments that Janet Yellen put out there. We did hear some printed comments before she delivers them at 10 a.m. Just to give you a sense of one of the highlights. She says, our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. The concern about medium-sized banks having some broader systematic kind of implication. We're seeing an 0.8%, almost 0.9% gain on the S&P. Yields higher, but not a lot of drama based on the tumultuous couple of days that we've had here. 3.56% on the 10-year. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is studying ways to guarantee all bank deposits if the current crisis gets worse. That's a move sought by a coalition of banks. Bloomberg's learned the Treasury Department is looking into whether regulators have enough authority to temporarily insure deposits larger than the $250,000 limit without consent from Congress. PIMCO and Invesco are among the biggest holders of the Credit Suisse bonds that have been wiped out after the takeover by UBS. PIMCO holds about $807 million of the so-called additional Tier 1 bonds. Invesco has around $370 million of them. AT1 bonds offer attractive returns in good times, but takes the first hit when a bank runs into trouble. The Prime Minister of Japan is becoming the final leader from the group of 7 nations to visit Ukraine since the Russian invasion. Fumio Kishida is meeting with Ukraine's President Volodymyr Zelensky. Japan has sent non-lethal military equipment to the Ukrainian forces. It's also imposed sanctions on Russia. Bloomberg has learned that Vanguard has decided to close its remaining business in China. The U.S. asset management giant has notified Beijing it will shutter its unit in Shanghai, abandoning a $3.9 trillion fund market. It's also exiting a joint venture with Ant Group. Vanguard's peers such as BlackRock and Fidelity are still building up their Chinese operations. And rent increases in single-family homes in the U.S. slowed down for the 9th straight month in a row in January. That pushed the annual rate to the lowest since the spring of 2021. According to CoreLogic, the typical rent for a single-family home rose 5.7% from a year earlier. Orlando led the way with an 8.9% increase, followed by Charlotte, New York, and Boston. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
We have a self-induced crisis by irresponsible fiscal monetary policy the last decade. I did not forecast the Silicon Bank issue, but I did have a view that we were heading to a crisis of some kind, and we've seen it.
That was Leon Cooperman, chair and CEO of Omega Family Office, who made his name over decades with single stock picking. And that's what he says we're going back to at a time when there is so much volatility, where he expects middling returns for the overall benchmark indexes, trying to parse through where we are now as we see a bit of a lift, a bit of a reprieve after days of some real angst, particularly in the bank stocks. Right now, we are joined by somebody with intimate knowledge through the cycles, as well as understanding how to play in some difficult moments. Dan Greenhouse, chief strategist at Solus Alternative Asset Management. How are you understanding, Dan, the bank distress that we've seen so far and how far it goes?
Well, listen, we're still in the early stages of this. I think it's pretty clear. We've got a couple of banks having already failed, another couple of teetering, but it's pretty clear that there are these, I don't want to use the word systemic, but there are these issues that are plaguing a number of banks that are going to result in a number of outcomes. It's going to be a compression in net interest margins as these banks have to pay up to attract deposits. It's going to be a decrease in loan growth, which, while not necessarily a substitute for rate hikes, is going to somewhat do the Fed's job for it in curtailing economic activity. It's going to be a higher regulatory burden on those mid-sized, but the 100 billion plus size banks. And it's probably going to mean consolidation in the sector as well. What it means for the economy at large is in my mind probably only going to be negative through that loan channel. I think there's a lot of people running around talking about how this isn't 2008 as if that's somehow okay. But while the issue itself is not at all arising to the 2008 levels, I think in an environment that is now characterized by elevated interest rates, what's happening in the banks isn't going to make things any better from an economic standpoint either.
You raise a really important point, Dan, and I don't think that this has been emphasized enough. People talk about what's going on as being a sort of temporary tightening, that they're going to pull back on some of their credit expansion, at least in the near term, as some of these banks decide how much they can count on deposits. But you're talking about a longer term consequence of less lending. Can you talk a little bit about which sectors of the economy that affects the most, which sectors of the economy these banks tend to dominate in when it comes to credit expansion?
Well, we know, and I'm certainly not the first one to say it, and I won't be the last, but we know that the commercial real estate market, which is already weak, is probably going to be weaker. A lot of the smaller and mid-sized banks do most of the lending. I forget the exact number, but even though smaller banks have only about 40% of the banking system's deposits, they represent about 50% of the total loan book for the economy as a whole. So they punch above their weight in that respect, certainly with relation to their deposits. And the first point you have to look at is the office market and the commercial real estate market. There's something going on in the cities right now that's going to have, it's going to take multiple quarters, if not multiple years, to fully play out as some of these leases reset. And you can see this in the public markets for those very large office REITs. They're telling you something is not right, and this type of a situation obviously doesn't aid that aspect of the economy at all. It's quite negative, to say the least.
What does something is not right mean when it comes to the trajectory of the economy in terms of when we see a recession, how deep it will be, what we look like on the other side?
Well, from an office standpoint specifically, we know that depending on which city we're talking about, the return to office, if you will, is running anywhere from 40 to 60%. There are some cities that are less, there are some cities that are more, but let's round and say that on balance in the office market across the country, and certainly in call it the 10, 20, or 30 largest markets, you only have about half of people back to work in any regular capacity at all. So that as those leases roll off, everyone's going to be dealing with the repercussions of what that means from a lending standpoint, from an occupancy standpoint, from a bank regulatory standpoint. That's that sector specifically. For the economy as a whole, I haven't done the work myself, so I'm not going to lie and say that I know exactly how it pans out. But the curtailment of loan activity, which is probably going to persist for several quarters now, is not going to take a weak economic or an increasingly weak economic environment and make it any better. The Fed, as we know, has interest rates at elevated levels. I don't think they should raise rates tomorrow, but neither do I think that is the end of the tightening cycle, because inflation is still running at quite elevated levels. And to repeat a point I've made numerous times, and it can't be said enough, yes, the year-over-year rate is coming down, but the month-over-month rate, either at the headline or at the core or at super core, is at concerning levels from the Fed standpoint. And that's much more consequential for what the Fed should do. So even though in the immediate, they may pause raising rates tomorrow, and I think ultimately that would be the right decision. when you're dealing with 0.4, 0.5, 0.6% readings on CPI, there's very little they can do in terms of easing to alleviate this crisis at all.
So your vantage point is coming from Solis, which is an alternative asset management company that oversees distressed debt opportunities as well as long opportunities. I'm curious where you're sort of seeing the most potential at a time when a lot of people are struggling to get their hands around exactly what the end result will be.
Well, I don't think the full ramifications of this episode has fully played out as of yet, and that's going to take a couple of quarters to do so. In what form and exactly what sectors, obviously, we'll be on guard for. In the meantime, I think there are plenty of opportunities for a fund like ours. I mean, obviously, you would like to see exponentially more distress, exponentially more defaults, which we don't have as of today. But there are still plenty of sectors of the economy that look attractive to us without weighing in at all about what we own or what we may be doing. There's the change in behavior at office I mentioned is something worth exploring. Who are the winners and losers there? On the content and the media distribution side of things, there's a change in behavior there that I don't think people are appreciating with what it means for the streaming services and the movie theaters and the vendors and those types of companies. In the travel and leisure space, hotel, cruises, skiing, and those sorts of sectors of the economy, there's a tremendous shift going on in consumer behavior. And so there, in each one of those sectors and others, there are clear winners and losers on both the debt and the equity side of things. And our job is obviously to sift through them to find out where there are mispricings and exploit them. And again, even though we haven't seen the full ramifications of this episode, in the meantime, I think we're actually pretty busy. And I think there's plenty of stuff to be looking at and exploring.
In the aftermath of the great financial crisis, one of the most lucrative trades was Lehman claims. They were claims from Lehman Brothers after they collapsed, and the returns were pretty astronomical. I'm wondering, Dan, if there's an analog here with the AT1s, with the contingent capital bonds, maybe not from Credit Suisse, but from other banks that possibly don't look money good for a second, and then all of a sudden the regulators step in and say, actually, it's a pretty bad precedent to set. Is that something that looks like it has potential as other investors see this as uninvestable?
Well, if there's, as I'm now midlife in terms of my working career, I will say that the bad precedent to be set is set in every crisis, and never put it past lawmakers to set bad precedent and exploit these opportunities to quote unquote change the rules. With respect to the AT1 market, listen, that story is clearly unfolding. You can see in the performance of the various bank entities who has better language in their documents than others. I don't know that we're not traditionally a financial fund, so I don't want to say that we have any particular expertise in this, but clearly that market is going to be ripe for exploitation going forward. I think it's going to be at the outset, it looks like it's going to be very difficult for investors to not think that there is additional downside, to say the least, to those investments. And again, that's not a small market. That's 250, 270 billion, depending on how you measure it. And considering 16, 17 billion of them were just wiped out when people did not think that was what was going to happen, I think people are going to be taking a much closer look at the rest of that market.
Just real quick here, does it also change the investing landscape for all things Switzerland if they're willing to change the documents on something like this, or perhaps interpret it creatively?
Well, to get back to my other point, I wouldn't comment about Switzerland specifically, since that's no particular expertise of mine. But for governments as a whole, there's a very famous saying: if you don't like the law, get a new lawyer. And I think whether it was 2008 or the European debt crisis early in the 2010s, excuse me, or what's happening now, among others, lawmakers and policymakers and politicians have never failed to change the rules to suit their needs. And in some cases, that's the right course. In some cases, it's not. But I think everybody has to understand that in a crisis is likely to be the outcome.
Dan Greenhouse, thank you so much for being with us. Dan Greenhouse of Solis Alternative Asset Management, as we try to make sense of a market that has been anything but calm over the past couple of weeks. We have seen a round trip in the two-year yield, S&P, a lift this morning as we reassess some of the comments from officials. Coming up on Bloomberg Television and Radio at 12 p.m. Eastern, Kathy Wood, Chief Investment Officer at ARK Investment Management from New York. This is Bloomberg.